There is a little bit of a handing off of the baton here from trade and taxes to the Fed.
The Fed shouldn't be cutting rates. They're not in the position to cut rates.
I expect Fed's playbook isn't going to change a whole lot.
Risk assets don't really care as long as the idea of rate cuts keeps being alive. That is totally fine.
The question really is, of course, around the September meeting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, it's Fed Decision Day.
I call him too late, pal, because he's always too late. Am I allowed to appoint myself at the Fed? Anybody would be better than Jay Powell. He's a knucklehead. Well, I'd love him to lower interest rates. Other than that, what can I tell you?
Fed Chair Jay Powell stepping into an uncomfortable spotlight following months of pressure from the White House to cut interest rates. Investors will be looking for some signs of dissent on the FOMC. The decision just hours away.
So we're going to get a lineup of guests this morning telling us the Fed meeting, we're going to anticipate it so much, and they are not going to consider it as important as the earnings and as the economic data coming out this week. But everyone's watching. We'll be actually on air at that time, so if you want to watch us, go ahead. The reason why is because of the political ramifications of this. I'm sure that there will be one President Trump also watching this meeting. The key question is, how does it get messaged at a time where they're likely to hold rates, at a time where the President of the United States keeps saying, too late, is holding rates unnecessarily tight, terrible, horrible. Let's see what he does. Let's see what the White House responds with when they do hold rates steady.
The next meeting after this one is September 17th. We've got 2 jobs reports, 2 CPI reports. The chairman of the Federal Reserve has every single reason in the world to make this very, very boring later on this afternoon. And there's a couple of individuals in the FOMC that might do their best to make it entertaining.
Well, entertaining for one person in terms of campaigning to be the next Fed chair, and that is Michelle Bowman, as well as Chris Waller. This would be the greatest descent on the FOMC going back to 1993, and it harkens back to the 1980s when the Reagan White House kind of stuck a couple people in the on the Fed's board in order to skew things, and you had some dissent, and it was a much more kind of volatile committee. Are we heading back to those days? Is that actually appropriate? And this, I think, is an important conversation. It's one thing to say it's politically motivated. It's another thing to say that on Wall Street, there is incredible disagreement about where we are in the economic and inflationary cycle, and incredible disagreement on how much we should cut rates. So as much as we want to cast this all in a political light, and properly, it also has a big economic debate underpinning it.
The debate is actually interesting on both sides of the demand day. It's not just about inflation and tariffs on the labour market. If you go to the statement, and we'll be looking at the statement this afternoon, when the Federal Reserve says the labour market is solid, you've got a Fed governor coming into this meeting making the case that the labour market is on the edge. And I'm looking for any subtle change in language in that statement later on this afternoon.
How does a Fed chair that has designed his entire chairmanship on consensus building deal with dissent in a graceful way? That will be a very interesting moment at the press conference and in the statement.
What a day we've got coming up for you. A Federal Reserve decision and news conference with Chairman Powell. Lots of earnings and lots of economic data. Coming up this hour, we'll catch up with Stuart Kaiser of Citi as stocks snap a 6-day winning streak. John Lieber of Eurasia Group with Fed Chair Jay Powell under pressure from the White House, and Angelo Zino of CFRA looking ahead to earnings from Microsoft and from Meta. We begin this hour with stocks steady as traders await big tech earnings and a Fed rate decision. Stuart Kaiser of Citi writing earnings are the biggest risk for the week and unemployment the most important for the next 3 months. Stuart joins us now for more. Stu, good morning.
Good morning.
Just how relevant is this Federal Reserve?
I mean, they're all relevant. Don't get me wrong, but I think to your point, they would like this to be as irrelevant as possible. I think unless they signal that the inflation data they got a couple weeks ago actually changes their thinking and their thought process on the path of rates, I think, the market, this is going to try to be a nothing done type event. There's always a risk, and I think the risk here is that they skew a little bit more hawkish. But all in, they've got, to your point, a lot of data coming up. They also have Jackson Hole, which they can use as sort of a quasi-FOMC meeting about a month from now, and I think that gives them a lot more freedom to be flexible today.
It's a long runway into September. You've got a sort of a 1 month view and a 3 month view. In the near term, the earnings. We've got Meta, Microsoft later. In the longer term, the next 3 months or so, the labour market and unemployment, just kind of frame that for us this morning.
Yeah, I mean, I think to us that's been the most probably unemployment rate has been the most important data point you get, for a while now. And I think to the extent that if the Fed is cutting rates with a 4.1% unemployment rate and you're an equity investor, you have to probably really appreciate that help. If you get the unemployment rate rising up to around 4.5%, then in our view, a couple rate cuts is not nearly enough, and that'll put a lot of pressure on the Fed to cut more aggressively. But if they're also getting a little bit of a tariff impact on inflation, it creates some kind of dual mandate issues for them. So, look, the U.S. consumer has been the white knight of the global economy for a long time now, and to us, that weakness in that part of the economy is by far the biggest risk to the market.
What weakness? And I say this because, yes, we did get JOLTS data, job openings data yesterday that came in slightly lower than the expectation, but the quits rate's still holding in there. And a lot of the other surveys have shown quite a bit of resilience and stability. What weakness and cracks are you looking at that gives you a sense that maybe we could get up to 4.5% unemployment rate?
I think at this point, you'd actually need to see job losses, right? To your point, the labor market feels like it's in a state where you don't have a ton of layoffs, you don't have a lot of quits, but if you do lose your job, it's quite hard to find a new job, et cetera. So I think what economists see that, they view that, to John's point, the labor market's on edge. There's some weakness and some fragility there. But I think until you see actual layoffs from corporate America, the market's going to try to look past this stuff.
There are a couple of different stories that are kind of layered on top of each other, which is one reason why it's been such a difficult market to understand this year. One of them has been the earnings story, and the AI story in particular. We get Meta and Microsoft today after the bell at a time where capital investment has just been through the roof. At what point is this market really hinged on the idea that continues, this idea that capital expenditures has to keep accelerating in the AI space?
Yeah, I mean, I think that's probably the single most important thing we get later today. Obviously, the earnings guidance matters, but it's the CapEx guidance. If we look back to Google last week, they actually increased CapEx again this quarter after a massive increase last quarter. So, look, I mean, that's the key to U.S. equity markets now. It's the key to the earnings outlook. And frankly, I think it's the key to the U.S. versus rest of world, discussion as well. If you want to be in that AI trade, you kind of have to be in U.S. equities. So, that CapEx is kind of the fulcrum for a lot of stuff, valuation, earnings, and also kind of relative performance globally.
Stu, just to build on that, does it make this equity market in America that much more resilient compared to, say, Europe? The numbers coming from Europe this morning, Adidas getting hammered this morning, not signaling much confidence at all. Porsche, Mercedes cutting their outlooks. China a problem. Tariffs may be in the future a problem for them as well. Just describe the character of the US market versus, say, Europe, and what that means for the resiliency of those individual stock markets through the rest of this year.
Yeah, I mean, I think if you look back the last couple of years, I would argue that U.S. exceptionalism has been a combination of fiscal spending and the fact that we have large cap tech and growth stocks in the U.S. that frankly just don't exist in a lot of other markets. If you want to invest in AI and large cap tech, you maybe have a small number of companies in China at the top end. You have probably a handful of companies in Europe. And then you have the U.S. And I think I was in Europe a few weeks ago, and I was surprised at how underweight the AI trade a lot of those investors felt, especially after 1Q earnings when the CapEx guidance got pushed so much higher. So, look, the U.S. has large cap, it has growth, and it has, tech and AI. And I think what that means is there's just a gravitational force kind of pulling dollars into the U.S. market that you just don't have elsewhere.
It begs the question this morning, what is the compelling case to make today for superior returns on the continent for the foreseeable future?
Okay, perfect example for this. And as you were talking, Novo Nordisk, the weight loss company, I think of them, given some of the drugs that they have, used to be the second most valuable company in Europe. After yesterday's sell-off, is the sixth most valuable company in the index. It just shows you how much they're hinged on luxury and weight loss in the idea that is sort of not necessarily with the AI trends.
And the market cap is something like 10% of one of the mega cap stocks reporting later.
Exactly. This is the reason why people are watching what happens in the U.S. with Microsoft and Meta and saying that determines U.S. exceptionalism more than almost anything else at a time when you're facing off with what we're seeing over in Europe.
Stu, can I pick up on a little bit of tension maybe in your call between the earnings from big tech and what might happen in the labour market over the next several years? The companies that will be responsible for developing the technology that might lead to job losses are the companies that might do the best over the next several years. Are you expecting some kind of divergence between how big tech performs and labour market developments over the next several years?
I mean, it definitely could be the case. There's been a lot of articles written, and we see it as well on Wall Street. Is this AI it replaces a lot of the mundane tasks that that we all do, and I think what you're seeing in that is, in a very simplistic way, is continuing claims. Right, continuing claims are very, very high. If you lose your job, it's hard to find another job to replace that, and that may not be AI today, but that dynamic is what people are worrying about. With AI in the white collar space in particular. So yeah, there's an opportunity or risk there that these companies continue just to sort of acquire wealth and market cap and earnings at a time when it is sort of a negative impact, at least a down market on the unemployment rate.
Given how many question marks there are, and given the lack of clarity when it comes to the forward trajectory of the economy as well as just corporate developments, are you surprised there's been such little volatility, that the VIX has just fallen off a cliff?
Over the course of the last couple of months, yeah, or last month or so, yeah, realized volatility's collapsed. This is a little bit sort of how you evolve out of crises, though, is, you get this massive, surge of volatility for a period of time. The VIX goes high, the curve inverts, and then, people de-risk. And vol becomes sort of, self-correcting to some degree, and that brings the VIX down. But I think what you're seeing now is the VIX is low, but the VIX term structure is very high. So the market is still pricing risk kind of in that 3 to 6 month window, even though the front of the curve is quite low. Look, if you look at Two things I think are contributing to that. One is like vol target investors, systematic investors. They've bought the market 41 consecutive days. And the second would be we're on pace for a call at $1.2 trillion in buybacks. That's $5 billion a day of equity being bought. So I think once you take out the aggressive selling and then the re-risking, which is what we saw kind of into April and then out of April, what you're left with is systematic and more slow burn kind of money coming into the market, which has suppressed volatility. Obviously, everybody at Wall Street would like a little more volatility. So I'm not celebrating it. I'm just trying to, explain where it might be coming from.
It makes sense. Stuart, it's good to see you. As always, thanks for being here. Thank you. Stuart Kaiser there of Citi on a range of issues. One being, we could have some negative developments in the labour market, but continue to have positive developments for the stock market. Yeah, and you really highlighted a key point that people are looking at. The economy is not the market, and what we've seen is the biggest winners might be doing so at the expense of certain human mundane tasks that can get replaced by some of this AI development. If I was to start an ETF, I'd call it payroll protection, and it would just be long NVIDIA, and that would be it. And I suggest that everyone should take out that option, that insurance package. Yeah, it's called the NASDAQ, which is the reason why people are buying U.S. equities. It does go to the heart of the lack of clarity on exactly how this is going to evolve. And it's a question that we're going to hear in earnings calls from a lot of big companies, how they are adapting AI, whether it's with efficiencies or whether it's retraining. Equity futures positive this morning by 0.1%. Looking forward to $11 trillion of tech earnings across just 4 tech names over the next 24 hours. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara. Hi, John. The U.S. and China have wrapped up 2 days of talks in Stockholm. The Chinese trade negotiator says they agreed to extend their 90-day tariff truce, but Treasury Secretary Scott Bessent said the Chinese may have jumped the gun a little. Bessent saying extending the pause another 90 days could be an option, but the final decision would be up to President Trump. Meanwhile, a massive earthquake off Russia's far east has sparked tsunami warnings across the Pacific. The quake was a magnitude 8.8 off the Russian coast, the strongest since 2011 when an earthquake off Japan's east coast sparked a tsunami that led to the Fukushima nuclear disaster. Hawaii saw 4-foot waves before some alerts were downgraded to warnings and evacuees were allowed to return home. And Blackstone's offices in Midtown Manhattan will remain closed this week, and it's unclear when they will reopen following Monday night's shooting. Among the 4 killed was a Blackstone employee. NFL Commissioner Roger Goodell says NFL employees who were the intended target of the shooting should work from home until at least August 8th. That's your Bloomberg Brief. John? Yahara, thank you. We'll have more on that story later on this hour. Up next on the program, Trump versus Powell.
I call him too late, pal, because he's always too late. Am I allowed to appoint myself at the Fed? Anybody would be better than Jay Powell. He's a knucklehead. Well, I'd love him to lower interest rates. Other than that, what can I tell you?
Up next, we'll catch up with John Lieber of Eurasia Group, live from New York City this morning. Good morning. The week begins a little bit later this morning. Check out this lineup. 8:30 Eastern Time. Economic data, Treasury refunding later on this afternoon. Chairman Powell and a Fed decision. And then after the close, earnings from Meta and from Microsoft. That is a packed 12 hours coming right up. Equity futures on the S&P 500 just about positive this morning by 0.1%. On the Nasdaq up by 0.2. Your small caps up by 0.4. Under surveillance this morning, Trump versus Powell.
I call him too late, pal, because he's always too late. Am I allowed to appoint myself at the Fed? Anybody would be better than Jay Powell. He keeps the rate way up. I think it's Trump derangement syndrome. We have a moron at the head of the Fed. I think if Jerome Powell stepped down, it would be a great thing. He's spending $2.5 billion rebuilding the Fed. I talked about the concept of fire him. I said, what do you think? Almost every one of them said I should. He's a knucklehead. It's a tough construction job. It looks like it's about $3.1 billion. It went up a little bit. Or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out. Well, I'd love him to lower interest rates. Other than that, what can I tell you?
Here's the latest this morning. Fed Chair Jay Powell expected to keep policy unchanged in the face of rising pressure from President Donald Trump to cut interest rates. Bloomberg's Tyler Kendall joins us now for more. Tyler, good morning.
Hey, John, good morning. Well, we are expecting to hear from President Trump later on today. But as you mentioned, if the Fed's expected to hold rates steady, that means that the president is likely to be unhappy, as the White House has really expanded its list of criticism ahead of this FOMC meeting. As you heard, it's gone beyond the Fed's wait-and-see mode. It's stewardship of the economy, and it's really started to focus on Chair Powell's management of the central bank itself. And we saw that on full display last week when President Trump put on a hard hat and went down to the Federal Reserve's headquarters here in Washington to criticize the recent cost overruns of the renovation project that's currently underway. And we should say that there actually was sort of a sigh of relief after that tour, because President Trump indicated that he didn't think Powell's handling of the renovation ultimately amounted to a fireable offense amid speculation that the administration could be building a legal case here to remove him. But President Trump did say he made clear to Powell in private on that tour the path of monetary policy he wants him to take moving forward. The argument has also expanded into debt servicing costs for the U.S. government, something that Lael Brainerd, the former Fed vice chair and NEC director under the Biden administration, told me is an attempt by the administration, she says, to cover up the true costs of the reconciliation package, that one big, beautiful bill. Now, John, I did ask the Deputy Treasury Secretary Michael Falkender last year, in terms of economic outcomes that the Treasury is tracking, what would be the difference between cutting today and cutting in September? And he actually said that in his view, it's really about the big picture and keeping up with peer nations. Just another instance that we can add to this list of criticism. Of course, we should say that Jerome Powell has defended the central bank's approach and says that any decision will be made with non-political analysis.
Tyler Kendall with the latest down in Washington. Tyler, thank you. More from Tyler in the next hour. Something on the edge of dangerous. Is it fair to say things are a little quieter since that visit last Thursday?
It seems like he got it out of his system for now. This is the question. Is it sort of in wait-and-see mode until let's see what they do on Wednesday, today, given the fact that he's like, oh, terrible, how big the price was. And you had Jay Powell saying, not true at all. It was like a marital spat. And then he said, just lower interest rates and it'll all be good. So here we are. And what is the response post-Wednesday?
I'm not suggesting he won't say anything later. I'm just suggesting things are a little calmer, maybe in Washington.
Blow the steam off the top.
Possibly. John Lieber of Eurasia Group joins us now for more. John, we've got to talk about this and obviously trade, but let's just start with this. We've seen criticism of Fed chairs throughout the decades. Is there anything different about the criticism coming from this White House to this Fed chair?
Yeah, there's a lot different because Trump's been spending the first 6 months of his administration taking a really heavy hand with the rest of the executive branch and asserting authorities that I think a lot of people, including me, didn't think he had. I mean, he's shutting down agencies, he's firing federal workers, and he seems and he's removed bipartisan board members from the FCC and other boards. So this is clearly a real threat that the president's trying to exert more influence over the Federal Reserve Chair. We've seen presidents try to intervene with the Fed in the past. In the 60s, there was a legal opinion from DOJ that said that they couldn't fire him. And now it looks like Trump has the authority, or at least thinks he has the authority, to actually fire Powell. So this is a very different situation that I think we've ever seen with the Fed chair, at least in the last 40 years.
The president himself has acknowledged the fact that his term is up in May and he might as well just wait. Why cause the disruption between now and then? John, how are you thinking about the timeline, the process to replace Chairman Powell?
So there's an open seat on the board that comes up in January. And from what I understand, several of the nominees who want the job are trying to angle to get onto that open seat, which is a version of Scott Bessent's shadow Fed chair. You put somebody on the seat, an outsider that Trump likes, that person would kind of just tend their garden and vote for the 5 months before Powell steps down. And then they would become the chair whenever Powell steps down. I think that's one plausible path here, and possibly the most likely. But I think, I don't think Trump's going to fire him. I think probably he'll make the announcement in the November-December timeframe, and probably no later than January or February. That person will then take over in May when Powell goes away. But, this is not over yet. And I think that Trump has temporarily stopped threatening Powell. Today is an important day because if the Fed doesn't cut rates, let's assume Trump backs out again, and we'll have to wait and see what he says. Now, I do think the threat of the firing has gone down significantly after that visit at the Fed building last week. Trump seemed satisfied that the building wasn't that opulent, that it wasn't that much on the cost overruns, and it wasn't that crazy. And I think he also got the message that firing Powell would be very bad for his presidency. So I think the threats have receded, and I think markets will continue to look through Trump's statements about the Fed today and later this year.
What's more important then to you from a policy perspective, John? What we hear from the Fed today and the response from the president, or the refunding announcement in a little more than 2 hours' time, when we get a sense of exactly how the Treasury plans to finance itself. This is actually a key component of this whole discussion, given that there plans to be more emphasis on issuing on the front end, which is more directly connected to that Fed rate.
Yeah, I think that's right. And I think that, this issue of where to fund on the curve is one that the Treasury's been putting a lot of thought into. They were very critical of the Biden administration for having borrowed a lot more on the short end. But now they find that that's where the demand is, and that's what they can do. So, I think this announcement will give some indications. This was something that the markets have been paying more and more attention to in the last few years. And given the enormous debts that the U.S. is racking up, these questions about how the U.S. is going to fund it, who's going to buy that debt, are top of mind. And I think the refunding is an opportunity for investors to get a peek as to the volume of treasuries that are going to be coming down the pike soon, which is enormous.
Maybe this is unrelated, John, but do you think that the fact that there has been some agreement between the U.S. and Europe and the U.S. and Japan gives some breathing room to take the pressure off the Fed, given that there will be the revenues coming into the U.S. Treasury from some of these tariffs that have been agreed upon?
That's probably right. I think we don't know the exact number that's coming in. It certainly is a nice little plug for the U.S. government. Let's assume it's $150 or maybe $200 billion a year in additional revenue. However, the government's running $2 trillion plus annual deficits. And over the long term, it's clearly unsustainable because of the U.S. demographic problems. So it probably helps in the short run. And I think that is going to be something that is important to pay attention to. But on the other hand, this makes virtually no difference in the long run picture of U.S. deficits.
Hey, John, appreciate your time. As always, John Lieber there for Eurasia Group, looking for that refunding announcement at 8:30 Eastern Time. The Federal Reserve, refunding, GDP, tons of earnings. This 24 hours ahead of us is absolutely packed.
It's pivotal. It really creates the halfway mark in 2025. It's shocking to think that we're just halfway through this year. And we look ahead until the second half where things get a little bit more interesting in terms of the ramifications of some of these policies. We might start to see it in earnings, but really a number of economists and analysts say the proof's in the pudding in the second half, in the third quarter, in the fourth quarter.
We have clarity on the policy now.
Correct.
To some extent, at least we know what the deal with Europe's going to look like with Japan, and we're going to kick the can with the Chinese for another 90 days, possibly. So we've got the clarity on the policy. They've got 2 more CPI reports. Question I would have for the chairman today is 2 CPI reports enough to get a decent read on how this is going to play out, not over the next several months, but over the next 12 months. At some point, you have to take a leap of faith. If it's not today, when is it?
Yeah, and to that point, and this is the reason why you keep focusing on the labor market, how telling is the labor market that is resilient and holding in there, like so many guests who come on our show talk about, versus the Chris Waller view of things and what other people say as well, which is there have been cracks. And they do suggest that there's a greater degree of weakness than maybe some of the headline numbers demonstrate.
That's the latest on what we can look forward to over the next 24 hours. Coming up next on this programme, we'll catch up with Sahm Lifrieri of Protective Countermeasures. The security experts look for answers following the tragic Manhattan shooting. Live from New York City this morning, good morning to you all. You're watching Bloomberg TV. Earnings in America just around the corner. 20%, 1/5 of the S&P 500 reporting across 4 names. That's more than $11 trillion in market cap. Huge companies, and their earnings reports are coming right up. Equity futures on the S&P positive by 0.1%. On the Nasdaq up by 0.2. 3 hours away from the cash open with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Some stocks on the move that reported after the bell yesterday. Visa being one of them. Those shares down almost 2%, despite the fact that they upheld their guidance for the year, earnings coming in solid. But analysts had been expecting that they would upgrade their earnings. The fact we didn't get that means that shares fell. On the bright side, the CEO saying that the consumer is healthy and they are spending. But that is a different story than what we heard at Mondelez. That's the maker of Oreos, of Ritz crackers. Completely different. Their North America sales miss. And there the CEO said that the consumer isn't healthy, that the consumer has anxiety, also saying that they did not expect to bounce back in the second half of the year because that's when tariffs will really start to hurt. So those shares down 2.5%. Elsewhere with consumer companies reporting, there was Starbucks. Yes, they did miss on a few figures, but the CEO, Brian Niccol, says that the turnaround is ahead of schedule and that things are going well. Those shares up 4.7% in reaction to that, saying that they were also going to unleash a wave of innovation in 2026. That includes things like protein cold foam. That sounds more like a science experiment than a drink. But either way, positive reaction to that, John.
Danny, hold up. What are they calling it?
A protein cold foam. I literally have no idea what that is. I only know those words.
How's that going to work? How do you drink foam?
Are you kidding?
You can drink foam. I can taste foam on something.
Oh, really? I actually really enjoy drinking foam. I have to be honest. Hold on a second. When you froth milk and then you just have the froth and you put some cinnamon in it, it's really yummy.
You
foam.
just have the foam.
That's I imagine that there's drink underneath
That's what
it,
I'm
but it's
getting
like
at.
right. So it's just, but it's sort of like it's sort of like sorbet except foam. If you want to lose weight,
this is not
protein.
Important. I'm getting lost in it.
Okay, yeah, but I think that it's something that's really
first time I've heard
deep
of it.
dive.
Okay, Danny, thank you. Thanks for the distraction. Equity futures positive by 0.1%. Let's get you some top stories. On our radar this morning, a divided Fed. The central bank widely expected to hold rates steady today, but Fed Governor Chris Waller and Vice Chair for Supervision Michelle Bowman signaled they might dissent.
So how does a Fed chair who has designed his whole chairmanship around consensus message this? And then I think it's going to be really important. How much does he really lean into the idea that there's economic justifications on both sides of the argument at a time when that's really where Wall Street's at, but there is a pretty loud mouthpiece at the White House screaming down his neck. I mean, really, the reason why this feels like a marital spat is because it felt like they were looking at their balance sheet and bickering over line items.
This is the president and the chairman.
President and the chairman. Okay. So I just wonder how much he's going to cater to that relationship in addition to the relationship of the different Fed members.
Do you think it's possible that the division within the Fed might be a strength for the chairman today and not a weakness? That you can say it's difficult to provide a consensus right now because there are two very different views of the world. And essentially, Governor Waller did this for him a few months back when he put out a speech and it was called A Tale of Two Outlooks. And he could present today a tale of two outlooks. You could say on the one hand, some officials are expecting this. On the other, some are worried about this. And we want a little bit more information, 2 CPI reports, 2 payrolls reports, to get back around the table in September, come out with some new forecasts.
A strength for Fed Chair Jay Powell in the eyes of who? I think that is the important question, because right now, you are absolutely correct. Right now, Fed Chair Jay Powell largely is endorsed by this market and said a lot of people think he's doing a good job. There is this question of how much is he catering to one person in the White House the way that other people speculate that some governor members are doing so.
Mr. Chairman, good luck. 2:30 Eastern Time for that news conference. The president setting to make the call on the US-China trade truce before it expires in 2 weeks' time. Chinese officials saying the latest round of trade talks landed on an extension, while the US Trade Representative Jamieson Greer said they jumped the gun. So where are we?
Yeah, big question mark. The expectation in markets is that the can will get kicked. It would be a huge surprise if President Trump tries to disrupt that in any kind of way, although there still are questions of what's being achieved in each of these negotiations, these extensions, especially given some of the concerns that people have about the concessions that are made in each of these particular meetings.
Yeah, particularly the relationship between the EU and the US. Just where are we on that front? How much pushback are we going to see over the next several weeks? I think one official in the administration yesterday said if they don't agree it, the tariffs going up.
Yeah, which is a pretty big threat given that you're hearing already different parties that are more extreme saying this is the reason why we want to leave the EU. And that's something that you increasingly hear in the Euro region as a number of member states say this wasn't a good deal for us.
Pushback continues on the continent. This time it's from European corporations. The tariffs are taking a toll on many European companies. Porsche this morning cutting its profit outlook for the third time this year. Adidas reporting weaker than expected revenue growth. And these companies starting to think about just how much this is all going to cost.
Yeah, one of the problems for particularly the auto manufacturers in Europe, and it kind of is a microcosm of the bigger story, is that they rely on two big markets disproportionately, the U.S. and China. Both of those markets present opposite threats in different ways. One of them competitively with just dumping vehicles, and the other one saying, we're not going to have as much demand for you in terms of the pricing. This creates a real headwind at a time where there already was an existential question around how quickly they were adapting to the EV revolution, et cetera. It just puts the whole economic growth story in Europe on tenterhooks. And that's one reason why we've seen some skepticism expressed, particularly through the currency.
I'm pleased you said this because it's not just China and it's not just tariffs. It's about whether the consumer actually wants electric vehicles from sports car manufacturers. That's the issue at play for that company.
Well, it shows that their margin for error was that much smaller because they already had been experimenting. And so they're at a weaker foot. And it shows that those with a stronger hand are able to maneuver through the threat of tariffs and the threat of competition from China. And those that kind of were missing it a little bit, whether it's Stellantis or Porsche, are feeling the pain that much more greatly. And I think that that's actually the story that really is encapsulated by the European auto manufacturers.
That's the latest from the continent this morning. Let's turn to the dominant story in this city over the last 24 hours. 4 victims killed by a lone gunman inside a Manhattan office building, making this the worst mass shooting in New York City in a quarter century. The victims have been identified, including top Blackstone executive Wesley LePatner. Joining us now, Shonali Bassett. Good morning, Shonali. A company in mourning.
A company in mourning, John. You have to remember that the building, of course, is still closed. You have very many companies that were housed in that building, but Blackstone in particular. Remember, the shooter was allegedly not looking for Blackstone. He was looking for the NFL. In the hallway, in the lobby, is where LePatner was shot as he was entering the building. I would say that people across Wall Street knew her very, very, very well because she ran a core business at Blackstone. This is a more than $325 billion real estate business at which she was a key executive, including the chief executive of BREIT, which is a more than $50 billion investment trust that connects to retail investors. It's one of Blackstone's biggest pushes. But she's also, this year, John, she joined the board of the Met. She, of course, was also on the board of the UJA Federation, so very close to the Wall Street Jewish community as well, and the Jewish community across New York. But remember, the people who were killed in this shooting were across very many walks of life in New York. So this shooting looms very large. Remember, the woman who died at Rakuten Management was not yet 30 years old. She was a very young associate. So still shaken, many people still working from home through the course of the week, certainly in that building. And in buildings nearby, people are back to work. But remember, the scene still looks like a crime scene in a place in New York that has become core Wall Street. Remember, these buildings are no longer downtown anymore. Most of the financial industry is now in Midtown nearby. So certainly this week does loom large across Wall Street.
Shonali, I'm pleased you brought this up. You know better than most who've always speaking to individuals at various financial institutions that are housed along Park Avenue. Executives over the last few years have made a massive push to get people back into the office. And I imagine over the last 24 hours, there's a greater degree of anxiety of employees of those companies about going into the office. How are the companies actually responding to this, to try and offer people securities that they're making the office place a safe place?
I'm glad you mentioned this because even before this happened, I had been talking to executives about just this matter, John. And you did see since the United Health executives killing just a matter of months ago, the very top ranks have increased security for themselves, of course. But in addition to that, this was a very strange shooting, wasn't it? I mean, the fact that he was able to get his hands on an assault-type rifle of that sort is certainly something that is hard to protect from. This is a building that was already very significantly secured. And the strange thing as well, John, is remember, this is in the August months in New York where a lot of people are not in town. So you can't really get a sense of how many people are actually coming in versus not coming in at this point in time. A lot of the executives in the companies I speak to say they're telling their employees, if you need a moment, take a moment. Don't feel like you need to rush back in. However, how long will that really last for? And how soon will employees be pulled back in neighboring areas? For Blackstone itself, remember, they also did say they had a town hall late yesterday morning saying that people need to take the time for themselves and grieve as needed here. But to your point on security, there has been increased security. I have talked to other businesses as well who are looking at increasing or reviewing security as we speak.
Shanali, appreciate the update. Thank you. Look out for Shanali later on Bloomberg TV. Let's build on some of this conversation with Sal Lifrieri. He is the president of Protective Countermeasures, a firm focused on providing risk and threat management solutions to corporations. He joins us now. Sal, welcome to the program. We want to do better.
Morning.
How can these corporations do better?
Well, I think, as the woman just mentioned, that the, security at the building, especially at that particular building, was relatively strong. He actually had uniformed NYPD, even though he was working off duty, but uniformed NYPD presence in the lobby. It's tough to increase it any more than that. So the problem, I think, that really is existing, and I think that this starts to show, is that when you have these situations develop, this guy didn't just snap. He didn't wake up one day and decided he was going to do this. This is something that happens over a progression of time. And there are particular indicators to potentials to violence that occur that are often overlooked. And, we've developed a program called the TAG program, a threat assessment group that works with corporations that actually looks at when you get that inappropriate correspondence that comes in. And more times than not, people just kind of throw it away and go, it's just a kook, it's a problem, it's nothing. And what we've seen over time is that it becomes something. It's a slow development. And the ability to get in front of it at that point to provide some type of counseling or interdiction is critical. Trying to stop it in the lobby in the moment when he walks in with the rifle is way too late.
Given that this was the most deadly shooting in Midtown in New York in some 20 years, from what you've seen, has there been a real increase in threats to different corporate offices, or is this just a really high-profile one-off that you can point to?
No, I think there are significant threats that are coming through. I think we see it almost on an everyday basis, right? 20 years ago, you didn't see the road rage incidents that you have today. The amount of anger, the amount of frustration that people are exhibiting, whether it's the economy, whether it's COVID, whatever it is, we're starting to see this uptick in it. And I think the other thing is, with the advent of social media, it makes it very easy now to reach out to people. Before you almost had to work to get to a CEO and to get something in his hands or to get to him. And today you can start off very slowly, and you can make these threats. So we're seeing an uptick along the way, where ultimately it winds up in violence. And, one of the other statistics I think is sort of crucial is when the shooting happened the other day, I think the statistic was something like that was the 245th active shooter situation we've had in the country since January. So the amount of violence there is just, it's starting to just uptick.
There's still a lot of questions, and I know that the NYPD has gone to Las Vegas to get more ground intel to understand exactly what happened here. What's the key piece of information that you're still waiting to learn to properly gauge what this threat was and how to better protect against something like this going forward?
Well, I think one of the things that they'll be able to do is when they get into the home to understand, get a look at the computers if they're still there, any electronic devices that he may have had, to see where that progression came from. Was there any information? Was there anything that was sent to the NFL? Were there other writings? Were there things that friends and neighbors may have seen a change in? I think while we're not looking for a prosecution because the perpetrator is dead, but what we'd be looking for is a good understanding of what the motivation was in this. And again, this wasn't a thing where he just jumps up one day and decides to do this, especially if it's proven to be true that it is CTE that he had. That's going to show over a period of time. And I think those are the indicators that we're going to be looking for. Did he write a manifesto, which seems to be going on? He did write a suicide note that he brought with him. So clearly he had an indication that this is what he was going to do, that he wasn't going to leave alive.
Tragic. Truly heartbreaking. Sal, thanks for making time for us this morning. We appreciate it. Sal Lifrieri there of Protective Countermeasures with an update on stories worldwide. With your Bloomberg brief, let's cross back over to Yahira. Hey, Yahira.
Hi, John. The U.S. and India are racing to negotiate a trade deal before Friday's deadline. President Trump says he may settle on a 20 to 25% rate, though that isn't final. Any levy of that magnitude would be a blow to India, which had been one of the first countries to negotiate and had been seeking lower rates than the 19% given to Indonesia and the Philippines. Meanwhile, HSBC shares are falling in London trading. The bank reported quarterly earnings that fell short of expectations as its CEO pushes through an increasingly costly restructuring. Expenses for the second quarter jumped 10% to $8.9 billion. And as the world's largest trade bank, it says it will see an impact from higher tariffs. And an Australian space rocket making the country's first attempt to reach orbit crashed shortly after takeoff. The Ares rocket exploded after 14 seconds of flight from a launch pad northwest of Brisbane. But Gilmore Space says it still considers the launch a big step for Australian capability and is setting its sights on another test flight. The launch came after months of delays. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira a little bit later on this morning. Up next on the program, a high bar for big tech.
I think we're going to see some pretty big CapEx numbers. I think we're on a path to $100 billion at Microsoft. We're probably on a path to $80 billion at Meta. So you put it all together, I think investors will reward it.
Up next, Angelo Zino of CFRA. Live from New York City, welcome back to the program. Under surveillance this morning, a high bar for big tech.
When I look at what's probably going to happen out of the likes of Meta, Amazon, and Microsoft this quarter, I think we're going to see some pretty big CapEx numbers. I think we're on a path to $100 billion at Microsoft. We're probably on a path to $80 billion at Meta. At Meta, I mean, the question is, are we going to see 18% top line growth? That definitely justifies this level of CapEx spend. At Azure, at Microsoft, my gut is we're going to be north of 35%. But you put it all together, I think investors will reward it.
Here's the latest this morning. Mag 7 stocks going into earnings season close to record highs following a 40% rally from the April lows. Angelo Zino of CFRA writing, recent strength from Microsoft and Meta means that they have the highest bars to beat. But we think both remain the cleanest AI stories. Angelo joins us now for more. Angelo, welcome to the program. Let's talk about those two names. What makes them the cleanest AI stories?
Well, and thanks for having me, John. I'd say overall what makes them the cleanest AI stories is, one, there's a clear path for AI monetization here over the next couple of years for both those names, I think. The other thing, too, is there's just less, there's less outside stories tied to it. For instance, with an Alphabet, you've got more legal regulatory issues out there. Apple's obviously got some of their issues. So there's a number, when you look at the other Mag 7 names, it just gets a little bit messy in terms of some of the competitive and legal regulatory issues that are out there. I'd say within those two names, Meta and Microsoft, you can also add NVIDIA, obviously among the Mag 7 names, which is also a very nice, clean story as far as the AI revenue trajectory here over the next couple of years.
Angelo, can we just sit on Meta? Is the more important number today going to be the CapEx number or the earnings number, the revenue figures?
So I actually think it's more of what the OPEX number is going to be for Meta. And, when you think about the CapEx number, they did hike it last quarter, right? So I think they actually got ahead, about a quarter ahead of everybody else in terms of hiking the CapEx number. And they actually did it back in April when visibility was very low at that point in terms of some of the tariffs and what have you out there. But they were looking long term, and we thought it made sense here. They could potentially increase CapEx again this quarter, especially with some of those, the 232 sectoral semiconductor investigation. We'll get an outcome here over the next couple of weeks, and that could potentially inflate some server prices out there. But at this point in time, we're looking actually for CapEx to be relatively sustained, maybe increase slightly. The OpEx number, I think, is what I'm a little bit more interested in. They actually tweaked it down last quarter. I think with some of these recent hires that we've seen, the creation of that superintelligence group, I actually think there's a significant bias to the upside in terms of OpEx, and that could potentially have a negative impact in terms of the earnings trajectory. But again, the most important thing is going to be the revenue here for the company. And based on what we saw out of Alphabet and what we're seeing from the digital ad landscape right now, I do think there is a bias to the upside where they could potentially beat by at least 200 to 300 basis points.
That is the most Wall Street way of saying that people are really going to look for the $100 million bonuses and some of these these capital expenditures that they seem to be making. It seems like we keep flipping and flopping from the nuts and bolts of balance sheet analysis to the hopes and dreams of the promise of AI. Which is it going to be that is better rewarded in this particular earnings cycle? It feels like you're saying the hopes and the dreams more than the nuts and the bolts.
I think it depends on the company, to be honest with you. In terms of the infrastructure plays, you think of a company like a Microsoft, and and even some of these non-Mag 7 names, right? The Oracles of the world. Those have been some of the best performing names this year, and because the reason for that is because you're getting immediate monetization of AI from those names, and that makes all the sense in the world. In terms of Meta, it is more the hopes and the dreams because you're not getting that instant revenue recognition from AI. This earnings call is going to be all about Zuckerberg really telling the AI story here over the next 2 to 3 years. It's kind of justifying some of those recent hires that he made and talking about the potential for them to really see a step up in AI monetization in 2026 and 2027, which we think he's going to be able to do. And we think there are a number of ways that Meta is going to be able to monetize AI across that app-based platform. So I think it all depends on the company, Lisa, but as far as Meta is concerned, it is more the hopes and dreams.
Do you think that Meta is going to change its name given the fact that the metaverse no longer is the hopes and dreams of this company?
So I've been saying I think they should change the name to Meta AI. So not necessarily fully change get the metaverse out of its name, but throw AI in there. But no, I don't think they fully changed the name. But I wouldn't be surprised if they threw AI across that name.
Angelo, credit to him. Just how adaptable is Mark Zuckerberg? His ability to say we're going all in this direction, then to accept that's the wrong direction and pivot and go elsewhere.
I think you give him all the credit in the world. I mean, one thing with Zuckerberg, and a lot of people often forget this, is he's got the voting power in that company, right? He can essentially do whatever he wants within Meta, which is something that a lot of these other CEOs necessarily can't do. So Zuckerberg is really kind of able to switch on the dime and kind of inflect it and change his thought process and throw that across the organization really quick. So, but yeah, I mean, you have to give the guy credit. I mean, he realized he was wrong back a couple of years ago. Realized he overhired, significantly cut costs because that's essentially what was needed to be done in an inflationary type of environment. And now he's kind of pivoting again towards going full force AI. And the street does like it because unlike the metaverse, AI does have that kind of, that revenue trajectory that I think Wall Street can see here over the next, 2 to 3 years.
Angelo, appreciate it as always. Angelo Zino there of CFRA, head of earnings from Meta and from Microsoft. This earnings call later, just a recruitment pitch to anyone at any other tech firm.
All you have to say is $100 million. I think your recruitment pitch is pretty solid.
Up next on the programme, Cameron Dawson of NewEdge Wealth, Heidi Crebo-Rediker of the Council on Foreign Relations, Courtney Breen of Bernstein, and the former St. Louis Fed President, Jim Bullard.
think we've had a great run. I think investors should feel good about that.
Industries with the strongest margins have been leading.
Values right now are not cheap.
The weak dollar, if that starts reversing, that will actually put some pressure on U.S. stocks.
No one wants to admit this, but the direction we're going in now, it looks like we are going to see better participation across the economy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. As we count you down to the opening bell, 2 hours and 30 minutes away, your scores look like this. Equity futures positive by 1/10% after snapping a 6-day winning streak in yesterday's session. On the Nasdaq 100 higher by 0.2%. The Nasdaq and Big Tech in focus later. Earnings from Meta and Microsoft. Tons of economic data at 8:30 Eastern time. And then the awkward one later on this afternoon. A Fed decision and Chairman Powell news conference.
You know who made it awkward? President Trump, by saying, too late's going to come to the podium. Look, he has a point with respect to the economic argument for cutting rates at a time when people don't see the inflationary pressures accelerating meaningfully over the next few years, stemming from tariffs, at least isn't sort of the premier economic look. That said, there isn't really a reason to cut right now, given what we're seeing in the underlying jobs economy. And so you're going to experience that descent for the first time in a massive way, going back to the 1990s.
There isn't a big difference between now and going into September. Got 2 more CPI reports, 2 more payrolls reports on August 1, September 5th, CPI August 12th, September 11th. I actually think the more interesting debate will be at the September meeting. You've got that data underneath you. You've got to provide some forecasts. And I think at some point you've got to make a call on this. You've got to make a call. Governor Waller's made that call. He's saying he doesn't think there's going to be that much pass-through. And the degree to which there will be pass-through, it's going to be transitory. That's basically his argument on inflation. He's made that call. Will the rest of the committee make their own call in September?
Well, and right now you're hearing more members actually suggest that that's the case, right? So it's not just Mickey Bowman and Chris Waller, 2 Fed governors. If they both dissented, it would be the first time that you get that kind of dissent on the Board of Governors going back to 1993. It's also Mary Daly. And she came out and she said, we can't just sit on the sidelines forever. You have to make a call at a certain point. Currently, there is a 66% chance of a rate cut baked in for the September meeting. This is why I think it is very interesting in September. If they don't cut, that will require a bigger explanation for the market, let alone President Trump, than if they do cut. And I think that that really sets up a pretty fraught meeting.
Citigroup says you can't hurry Dove. Do you like that?
That's beautiful.
I feel like they've used that one before.
I feel like that should be a song. And I feel like we're about to get a song.
No, because it is a song.
No, Hurry a Dove.
No, you can't hurry love. Oh my goodness.
Oh, sorry.
No. Oh, no, Bramo. We can't restart. We're live. Coming up, Cameron Dawson of NewEdge Wealth with stock snapping a 6-day winning streak.
I'm going to leave.
Heidi Crebo-Rediker, the Council on Foreign Relations on US-China trade talks, and the former St. Louis Fed President Jim Bullard counting down to a Fed rate decision. You going to be okay?
No, I don't think I am.
Okay.
I think I would have to bow out.
Let's begin this hour with stocks steady ahead of a Fed rate decision and Mag 7 earnings due out after the closing bell. Cameron Dawson of NewEdge Wealth writing, we are still in an uptrend, but this setup suggests some healthy near-time digestion. Cameron joins us now for more. Cameron, good morning.
Good morning.
Any comment on that and what just happened? Should we let that go?
Absolutely no comment.
Okay, great, guys. All right, I'll just be listening to Supremes over here. All
just describe the setup for us. What's on your dashboard right now?
Okay, we are going into a tougher seasonal stretch in the month of August. We typically see volatility pick up. We are having this position where we're starting with an overbought condition. We've seen valuations get to 22.5 times forward. Positioning has now gone from being deeply, deeply underweight in April to now modestly overweight. Still room to get more overweight. You've seen strategists chase this market higher by raising their price targets. You've seen sentiment rebound. All of this suggests that maybe we could have some digestion. Nothing to end the rally. We're still in an uptrend. There's still buybacks that are pushing things higher. Earnings revisions are still moving higher, but healthy digestion would be good.
So the question I'd ask then is how much capacity do we have to absorb some negative news if it comes from earnings, if it comes from the data through the summer? Are we going to be okay?
I don't think that the market would take it lightly simply because of what is priced in, given the fact that you are trading at such high valuations. If we were at lower valuations and positioning was very light and you saw people bracing for downside, that would certainly be something the market could take. But look at option volume. You have the percentage of call options being the highest since 2021. with put options being the lowest since 2021. This just suggests that people are only pricing in or expecting upside potential, not necessarily bracing for downside.
So Mama said you can't hurry love.
There we
you just
go.
have to wait. She said, Dove don't come easy. That's pretty good, right? I'm just telling you, I'm trying to redeem myself. It's failing miserably. I feel like crashing and falling. You're talking about this sort of high bar for any kind of downside surprise, or in terms of just justifying the bullishness that you're seeing currently baked into the market. Is there a dissonance between the hopes and the dreams for rate cuts and the optimism that we're seeing expressed in equity valuations?
I would say yes, given the fact that financial conditions are so easy and that equity valuations are high and credit spreads are tight. It's one thing for people to say the equity market is not the economy, but everywhere we look, we see high valuations. Whether you're looking at CLO spreads being near record tights, high yield spreads being very, very tight, all of this suggests that financial conditions are loose and easy. This is not a market that is begging for more liquidity. In fact, we see signs that liquidity is incredibly abundant. So to think about big, huge Fed rate cuts in that environment, there is that dissonance that you talked about.
Well, this is one reason why I think that today's tech earnings and tomorrow's tech earnings are going to be so important. A lot of the high valuation story has been justified by the idea that we're about to embark on this technological sea change that's going to rejigger our expectations of valuations and potential for growth and efficiency. Do you reject that? Do you think that that's not a valid argument? That's just basically pointing to the boogeyman to justify what people like to want to keep going?
Look, I think that there is reason for optimism to have this idea that AI could be a big step change function difference in the productivity of the U.S. economy. However, there's an interesting caveat, which is that we may be living in a digital world, but it is becoming increasingly more material, meaning that these companies are having to spend hundreds of billions of dollars on CapEx. So you are transmuting a capital-light business that was very software-driven, high margin, high return on invested capital, now having to throw a ton of capital at those businesses. That suggests to us that potentially return on invested capital goes down as you see more capital intensity because of the physical infrastructure that is needed to support this digital world.
Do you think the benefits are elsewhere in the equity market?
Eventually, yes.
But not yet?
We're not seeing signs of it yet. And I would say that the market is pricing in some idea that you are going to get that broadening of the AI benefits. Look at 2026 earnings. The expectation is for 12.5% growth. To get there, you have to bake in more than 100 basis points of margin expansion. That, to me, says that you're pricing in some kind of productivity benefit on a broad basis from this AI.
So just to pick up on this, do you think we're too bulled up on 26? Never mind 25.
Everybody is looking to 26 now and completely ignoring 2025. I think what ends up happening is that if 2025 numbers come in better than expected, you could effectively hold 2026 constant simply because you would not be needing as much growth. But 2026 prices in an acceleration in revenue, which in a decelerating nominal GDP environment, if that's what we get, stable real growth and deceleration in inflation, that becomes even more challenging. So at the 297, we don't see a lot of upside in those earnings from there.
You know, we keep saying that the economy is not the market and the market is not the economy. But what you're describing is something a number of people have talked about, which is for decades, there was more investment appreciation, asset price appreciation, and it wasn't going into the real economy. What you're just describing is that more and more of it is going to go into the real economy through investment in the physical world. We are becoming more material. Suddenly you have to actually create the goods to go with the technological advancement. Does that mean that you could see equity valuations stall out but gain in the underlying economy in a way that we haven't seen for a very long time?
I think that is the most fascinating point or question, which is that if you start to see more of this capital intensity, it would suggest that some of the left behind sectors like materials and utilities start becoming and staying much more relevant versus this world where we have constantly been seeing upside to margins because of the lack of capital intensity, because this was a software-driven kind of bull run really since the great financial crisis. So if that capital intensity picks up, we're seeing more investment within manufacturing. If we start seeing a pickup within PMIs, all of this suggests that maybe we should look at some of those more value sectors because they have been left in the dust over the course of the last 15 years.
Can all of that happen with rates where they are? I mean, this goes back to the Fed and capital investment, given the fact that we're still seeing that, even with rates that are considered, at least by the president, to be too high. Do you need to see them come down to really boost that cycle?
So it's really interesting that we're seeing this deceleration in real GDP from 2023 and 2024 into 2025. But I think it's really hard to make the argument that the reason we are seeing a deceleration in growth is because of the Fed. The real Fed funds rate is lower today than it was this time last year. We've gotten 100 basis points of cut, and core PCE has stayed about the same. So to argue that the Fed is so tight that this is the reason why we're seeing lower growth, I don't think that's the case. It's coming from other areas.
Cameron Dawson of NewEdge Wealth. Appreciate your time, as always. Chair Waller cuts 100 basis points next year, doesn't he?
That's the expectation.
If he gets the job.
Markets. Well, I mean, this is sort of the theory that the less they cut this year, the more they're going to cut next year, because it will ensure that whoever does get selected will be uber dove. They can find their love. It's really easy to find their dove.
Nice. You keep going, don't you? That's great. OK. Let's get you an update on stories elsewhere. Elsewhere, away from here for a moment with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. We start with Starbucks. Shares are rising 4.6% in the pre-market, even after the company posted a bigger than expected drop in sales and profit in the latest quarter. But investors are seemingly encouraged by CEO Brian Niccol's confidence in his turnaround strategy, with Niccol saying efforts to speed up service and improve staffing are ahead of schedule. Meanwhile, UBS posted higher than expected profit in the second quarter. The Zurich-based bank said earnings were aided by results at the investment bank, and in particular, a 20% boost in equities trading revenue. UBS signaled that the prospect of cooling trade tensions should continue to support their results. And 4-foot waves were recorded in Hawaii, and initial signs of a tsunami were detected in California and Indonesia after an 8.8 magnitude earthquake hit Russia. The quake was the strongest since 2011, when an earthquake off Japan's east coast sparked the tsunami that led to the Fukushima nuclear disaster. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira later on in the hour. Up next on the program, the US and China preparing to kick the can.
The Chinese deputy minister did say that we had agreed on a pause. We have not. Nothing is agreed until we speak with President Trump.
That conversation up next with Heidi, Crebo-Rediker of the Council on Foreign Relations. That's after the commercial break, a commercial break that Lisa will spend researching song lyrics.
No, I promise. It's over. You can come back.
We're done?
It's okay.
Moving
I promise. We're not going to mention anything again.
Equities are doing okay. Stocks are higher by 0.1% on the S&P. On the Nasdaq 100, higher by 0.2. Earnings later on this afternoon. Data at 8:30 Eastern Time. Chairman Powell and a Fed decision later on this afternoon as well. 2 p.m. for the decision, 2:30 for the news conference. Under surveillance this morning, the US and China preparing to kick the can.
We don't want to decouple. We just need to de-risk with certain strategic industries, whether it's the rare earth, semiconductors, medicines. The Chinese deputy minister did say that we had agreed on a pause. We have not. Nothing is agreed until we speak with President Trump.
So here's the latest this morning. The Treasury Secretary, Scott Bessent, expecting talks between the US and China to continue, suggesting that President Trump will make the final call on any extension beyond the August deadline. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington, Ollie Crook in Stockholm. So, Ollie, let's talk about it. Have we agreed to a pause, a truce, an extension? What have we agreed to?
Yeah, Jonathan, it depends who you ask. We had sort of two sparring press conferences here in Stockholm after those 2 days of talks between the U.S. delegation led by Treasury Secretary Scott Bessent and on the Chinese side led by the Vice Premier. The Chinese spoke first. They seemed to indicate that basically a truce had been struck, that there would be an extension to that 90-day truce in the trade war between the United States and China. Then we heard from Scott Bessent. He said, not so fast. We have not yet agreed to this. We need to first go back to Washington, D.C., brief the president today, and he will make the final determination ahead of that August 12th deadline. I think that the market took all of that in stride because both sides went to great lengths to say that the talks were very, very positive. They were very, very constructive. Despite the fact that they were apparently constructive and positive, there was not a lot of sort of palpable outcome in terms of some of the concrete issues, how to right the trade surplus, how to deal with one of the issues that the U.S. administration is taking on further and further, which is the continued buying of Russian crude oil. So I think, John, going forward, how we think about the trade negotiations with China is that these are discussions that will be sort of measured in 90-day increments. I suspect that the market is currently pricing that Trump will okay it, but we're still some distance before these two leaders, Xi Jinping and Donald Trump, can deliver anything concrete, which is why I suspect a summit is probably not quite on the cards anytime soon.
Tyler, maybe you can address this question. Just what it's taken so long. We all assumed we'd get a 90-day extension. Why haven't we seen it yet?
Well, John, the Treasury Secretary Scott Bessent said that he would be meeting with President Trump in the Oval Office today. There is an event on the public schedule at 1:30 p.m. Eastern, right before that Fed decision. So perhaps President Trump is going to speak then and make this more of a formal announcement, because it did seem like these U.S. officials really wanted to make clear that it is ultimately President Trump who is negotiating here and would be the final say on any sort of decision. Though we did get some of those positive indicators from the Treasury Secretary that it does seem like they are on track, that this really did amount to sort of a check-in to make sure that both sides were living up to the agreements that have been reached in Geneva and also London, particularly when it comes to those export controls. In fact, you heard the USTR Jamison Greer in the room that Oliver was in say that the U.S. never wants to talk about magnets ever again. They just want the assurances that those export licenses are going to keep flowing. And the Treasury Secretary himself defended the U.S.'s part in these negotiations when it comes to loosening some of those export controls around NVIDIA's H20 chips, for example, saying that he doesn't think it poses national security concerns. It seems that at the moment they were really just setting the stage to tee up President Trump to announce potentially this extension later on today, because, of course, they're against this background, John, of the August 1st deadline. And in all of those negotiations, officials have made clear that the final say rests with the president.
Tyler Kendall with the latest alongside Ollie Krug. Ollie, Tyler, to the both of you, thank you. Joining us now to extend the conversation, Heidi Crebo-Rediker of the Council on Foreign Relations. Heidi, welcome to the programme. I just want to pick up on two lines that came from the Treasury Secretary Scott Bessent. We don't want to decouple, we just need to de-risk. Is that the more diplomatic way of saying we want to decouple, but we're not in a position to until we de-risk?
I think you hit the nail on the head. I mean, decoupling is actually... I'm not so sure that that's the best final objective anyway. I mean, the de-risking is really because we have vulnerabilities where we have put all our eggs in one basket, particularly when it comes to rare earths, rare earth magnets, and the related technology and some critical minerals. Some other products as well. But, China really dominates that space. And we're trying to de-risk in the U.S., but it's and our allies as well. But it's very, very, very difficult. China has the chokehold on those particular commodities. And I think they're going to continue to use them, whether or not USTR Greer ever wants to talk about them ever again or not.
How much, Heidi, has the U.S. gotten more leverage when it comes to getting some sort of coalition of trade partners to work on tamping down on the threats that some perceive as coming from China right now? Do you think that they are in a stronger position if there is yet another 90-day delay?
So first, I think as to the 90-day delay, if it is what happens, I think that is the very best option right now. And the coalition of the willing is, to look at both the offense and defense. The offense meaning you want to be able to make the investments in all of the areas collectively that protect economic security from weaponization from China. You also want to make sure that if you're going to rattle the saber of Russian secondary tariffs or secondary sanctions, however you want to categorize them, that you have to be prepared if you impose those on China, that they're probably going to, reinstate some of those export control restrictions, because that is literally their choke point right now.
How much do you get a sense that that has been the crux of a lot of the discussions, particularly with the European Union, but also Japan and certainly in Southeast Asia, which has been a conduit for a lot of Chinese goods into the United States through those nations? How much has that been one of the main discussion points and part of the negotiations versus just sort of an ancillary part?
Oh, I think critical minerals and rare earths have been key. All the other issues that Secretary Bessent mentioned on overcapacity, that affects everybody. You have both developed and developing countries that are feeling the brunt of the auto, the use of tsunami on a day like today, but the tsunami of Chinese auto exports flooding markets everywhere from the EU to Brazil. But I think, the one caveat is that because we have proven ourselves, unfortunately, to not be the most trustworthy trading partner, and one of Trump's big objectives is really to upend both the trading and the security system, the architecture. I think there's not a lot of trust out there, and one thing that you really need when you're dealing with a coalition and building a coalition is you need trusted partners. So we need to make sure that we don't lose that trust along the way in order to be able to implement collectively some of the things that we want to do on economic coercion.
Heidi, it makes me think of Canada. Supposedly a North American friend of the United States of America, left out in the cold. And I've been surprised, I know you are too, that the two key issues really that are left on the table, put China to one side, it's Mexico and it's Canada. And we're not hearing enough, I don't think, about what's about to happen. What do you think is about to happen?
So, President Trump has been very dismissive of any deal being reached with Canada. And we traded more than $900 billion in goods and services last year with Canada. They are the country to our north. It's not a small player. They're our closest partner in addressing many things, including our critical mineral challenge. We've, a lot of the investments that have been really for shared economic security have been together with Canada because we are so complementary in terms of what we can both extract and refine and produce together for on the critical minerals front. So I think, I'm very worried about the fact that Canada has not been more front and center. In particular, Mexico has, it comes with a different set of issues. They're connected, but I think Canada in particular is one that I am truly worried about.
Heidi, do you think that's because they just haven't focused on it? Or do you think that's just the natural consequence of the fact that we have USMCA and we can renegotiate it next year? Which one do you think it is?
So, it's a good question. We do have the ability and obviously are going to renegotiate USMCA, but at the same time, the feeling that President Trump really likes to have all the cards to play and feels like Canada has very few cards to play because they haven't diversified. They're so tied to the U.S. economy, and they're really trying to figure out how quickly they can diversify their energy exports, their critical mineral exports. They have a very comprehensive political backing for de-risking from the United States right now. I think that's unhealthy. But I do also think that the president is going to use whatever leverage he has to strike the best deal he can. And but I do worry that he is probably more likely to be conducive to working with Mexico than he will be with Canada. And I'm worried about that.
Interesting. Heidi, thank you. Appreciate your time, as always. Heidi Crebo-Rediker there of the Council on Foreign Relations. I have some sympathy with trade negotiators right now. There's only so much they can negotiate until they renegotiate USMCA. So I guess with that in mind, it makes more sense to focus on other nations, on China, on Europe, on Japan.
It feels personal with Canada. Let's be honest. It feels personal coming from President Trump, when he keeps on talking about the 51st state. And it feels personal when you look at some of the numbers coming from Canada. Actually, the Bank of Canada said that they did a survey, and it showed that for the first time ever, 55% of Canadians say they are avoiding or spending less on vacations in the U.S. So there you go.
They've taken it personally. without a doubt. It's in the data, to your point. Up next on the programme, we'll catch up with Courtney Breen of Bernstein as Big Pharma braces for big tariffs, plus Danny Berger with your morning movers. Hershey, trimming guidance on tariff concerns. Just missed out yesterday on a 7th consecutive day of gains on the S&P 500 following 6 all-time highs. Still well on course for a 3rd straight month of gains on the S&P 500 this morning. Up by 0.1% on the S&P, on the Nasdaq 100 up by 0.26. Switch up the board and get to the bond market. 2-year, 10-year, 30-year bond yields this morning just about unchanged. Since the Fed last met, also just about unchanged. The 10-year and the 30-year yesterday, though, with a decent rally. This morning, 432.23. Yesterday, job openings a little bit lower than expected. Decent auction and a big event about 60 minutes from now.
Yeah, there was sort of a curious move in the 30-year bond. You saw the yield coming in more than 10 basis points, the biggest one-day move going back to early June. Is it really because JOLTS and the headline number, especially with the solid quits? Some people were pointing to that refunding announcement, which is what you're referring to, in about an hour time, and this idea that maybe we'll get a sense that the Treasury Department is going to issue a disproportionate amount of bonds on the front end, or debt on the front end, and maybe even reduce coupon sizes in the long end. And that, I think, is what people are watching out for.
Mike McKee's going to break down that story for us in about 60 minutes from now. The 10-year at 4.32, the 30-year at about 4.87. Let's get you an update on the stories elsewhere and get you some morning movers with Danny Berger. Hey, Danny.
Hey, John, I got some earnings for you. Humana reporting this morning, upping its guidance, something that has been very rare among health insurers. In fact, most of them have been cutting their guidance because of higher medical costs. Humana, on the other hand, said that costs were in line with what they expected. They also saw a big boost to both their pharmacy and their Medicare Advantage programs, so those shares up 7.5%. To the downside this morning, though, is Hershey's, the chocolate maker, gaining some back. It was originally down quite a bit, up now just about 0.2%. The issue for them is tariffs. Initially in May, they gave an update saying that the tariff cost for them would be $20 million. They now say it will be as much as $180 million. So they've had to revisit the cost there. At the same time, cocoa prices have doubled. They have also increased how much they are charging for that because of the shortages. Perhaps the fact they're able to pass that along is why you're seeing some of the losses trimmed. Finally, VF Corp this morning. This is the maker of North Face, of Vans, a turnaround taking hold for the company. They've been struggling with a lot of their business, but the earning comes in better than expected. So that gives investors the confidence. Shares are up 17% this morning, John.
It's a nice rally, that's for sure. Danny, thank you. More from Danny in the next hour. On our radar this morning, our top story. Blackstone's Midtown Manhattan offices will remain closed this week following Monday's shooting. The NFL commissioner, Roger Goodell, saying the league's offices, which are in the same building, will also be closed through August 8th. Elsewhere, President Donald Trump ramping up pressure on Vladimir Putin, giving Russia until August 8th to reach a truce with Ukraine or face economic penalties. The Kremlin responded, saying the country has, quote, and check this out for a quote, acquired immunity to sanctions.
And arguably, they've demonstrated that that has not been a deterrent when it comes to their incursion in Ukraine. Yesterday, we did see oil prices pop on the back of this. The idea that maybe this was something that was going to lead to sanctions and a real tightening of the screws in terms of oil exports from Russia. I just wonder about the timing of this. What triggered President Trump's desire to crack down a little bit more, at least in theory, in terms of the time frame? Was it the negotiations with the Europeans about how the tariff structure would work, and how much muscle is there behind this? And I think that's the other thing, because there have been a lot of threats, and we haven't always seen them come to fruition.
The two issues now fit quite neatly. Basically, the Europeans have agreed to buy $250 billion of energy every single year from the United States for the next 3 years. That number was running at something like 80 billion. If they're going to increase that number, it needs to drop elsewhere. And they need to completely cut off that energy relationship with the Russians, which still exists to this day, which many people find absolutely ridiculous.
Which underscores how the trade issues turn into national security issues, turn into geopolitics very quickly, and we see that on a mass scale. I will say it is notable that when President Trump was asked about oil prices and whether it concerns him that oil prices could go up, should he tighten the screws on Russia, he said, we can always pump more. We're good. we can always have that production tap turned on. So it seemed like he was diminishing that as a potential threat.
Arguably moving the crude market in the last 24 hours. Here's an update on trade. The president saying that India might be hit with a tariff rate of 20 to 25%. The two nations are working on a deal ahead of Trump's self-imposed deadline this coming Friday.
This would be a huge disappointment. They were hoping to get something below that 20% level, and there's a real question around what this relationship looks like, where some of the grievances continue. It goes to a point, though, that you mentioned earlier, John, is the business model of creating cheap goods outside of the U.S. and then shipping them in for fast fashion to the U.S., is that business model dying? And I think that really the idea that the likes of Apple, which was going to move their production from China to India, this question of where do you go that's safe from some of these potential tariffs, the fact that you can't find a place is really raising questions about that exact issue.
Nailed it and pretty much read my mind. I don't think you can underestimate how much that move by Apple irked this White House. At one point in time, if you go back a couple of months ago, India is almost at the front of the line to get a trade agreement with the United States. That move happens bang. And the president was vocal about it, very public, that he was unhappy with Apple and Tim Cook about moving production out of China into India. And remember the conversations we were having, and Dan Ives would joke about producing them in New Jersey? Right. I don't think you can understate the importance of that move and how much it derailed talks with India.
I wonder how much you're conditioned by experience. And this administration remembers back in the first Trump 1.0 when they came up with tariffs on China, and then all of a sudden Thailand and Vietnam, and then transnational shipping became a really important conduit of goods into the U.S. Was that sort of a telltale warning of what would happen if they didn't make that a bigger priority in this particular trade dispute?
That conference call with Apple later on this week, that's must watch. It really
Thursday.
is. Must listen.
Let's listen to the sort of disgraced diplomat, not disgraced diplomat, but the fallen diplomat, at least when it comes to the eyes of President Trump.
More diplomatic terminology there. Nice.
Trying. It's like...
Yeah, not doing so well this morning, aren't we?
Loving the dove.
Yeah. Let's turn to trade, keep it on trade, and turn to pharmaceuticals. The US Commerce Secretary Howard Lutnick promising, quote, massive tariffs on non-US made pharmaceuticals. Courtney Breen of Bernstein writing, we do believe that the pharmaceutical companies have already begun aggressively mitigating the tariff risk. We would anticipate that the 15% EU tariff will likely cause a headwind. Courtney joins us now for more. Courtney, welcome. Let's talk about those so-called mitigation strategies. What kind of mitigation strategies have been implemented by the companies that you cover?
With you this morning. I think one of the things that we've seen the pharmaceutical companies aggressively engaging in is actually just bringing forward stock into the US at a much faster and much earlier rate. So if we look at the data of pharmaceutical imports into the US, in March and April, after we saw some language around potential pharmaceutical tariffs, we saw an increase by 250 and 300% in the rate of pharmaceuticals being brought into the country. This has been specifically described by many of the pharmaceutical companies, and we have some clear anecdotes as to how long that pharmaceutical stock could last as well on the scale of years.
So, Courtney, once you've done that, I guess my question now, and the question of the White House would be, is 15% sufficiently high enough to redirect production, to get these companies to think about moving their manufacturing base?
It's a great question because these manufacturing networks are highly complex and they get built over decades. Many of the companies that I cover are 150 or so years old, and these manufacturing networks kind of resemble the fact of the age and the legacy of those companies. And certainly over the last few decades, there's been a real incentive to have a lot of that manufacturing anchored in Europe, anchored in some of these lower tax regions, where you can also pair that manufacturing with intellectual property and other value-added capabilities that mean you're able to minimize your profit exposure and therefore your tax exposure in the US. So to be able to make changes, it is incredibly hard because you'd be talking about perhaps actually turning a large site that has real capital investment in it off in one location and then trying to turn it on in another location. And to set up a new manufacturing site in a place like the US, we would be talking of a scale of about 5 years to go from a greenfield kind of no site in place to something that's able to produce commercial product. So there's time, there's money, and there's kind of untangling of the web of the manufacturing network that's sitting there already to be done. What we're more likely to see are some of the stopgap reactions. We saw the inventory pull forward already. We've begun to see some partnerships with CDMOs or contract manufacturers here in the US take shape so that pharma companies can import goods at a lesser finished state and finish them in the US, thereby minimizing their tariff exposure. And then we're also seeing kind of more work going on in sites that these manufacturing companies already have in the US, expanding sites, expanding the number of lines, enhancing the operational efficiency. And then the final step is, look, if you're really looking to expand your volume and you need to make a new manufacturing CapEx investment decision, of course, with this pressure, it makes more sense to now consider the US, but I don't think we're going to see wholesale kind of turning off manufacturing sites in one location to turn them on here in the US.
Courtney, my understanding is that the tariffs and some of the potential investigation is non-generics. It's the new drugs. Generics are not exposed to that. I just wonder what the consequence of this is. If there is some sort of ground-breaking medication, is there real price sensitivity? Is the real pushback coming from insurance companies that are going to have to pay the higher prices?
Yeah, you're absolutely right. There is a distinction between kind of branded and generic on the basis of what we've heard out of the EU kind of since the weekend and since the deal, where this 15% EU tariff will primarily apply to branded products, with most generics being excluded. If you think about the patient, the end user, what we know is in the US, 90% of prescriptions that are filled in the US are actually for generic products. So kind of most of the kind of interactions that a patient will not have this 15% tariff or any sort of pricing impact kind of wrapped within it. On the branded side of the equation here, we do know margins are higher. And what we do know is that the industry has more constraints than if you would compare it to an average consumer industry who can choose to raise prices as needed. In the government channel, so your Medicare and Medicaid, there are restrictions on price increases. Medicaid requires the lowest price available in the market. Medicare limits price increases to inflation and some other parameters that prevent companies from kind of passing this price or this tariff cost on. Similarly, in the commercial setting, often these contracts are set over a number of years or with highly competitive terms across a number of companies. And so your ability to just raise your price and kind of compensate yourself for the additional tariffs that you're paying is unlikely to be kind of fully passed through, and certainly not fully passed through on a timely manner. So we do anticipate some pressures in some of these companies who haven't been able to fully aggressively mitigate the near-term risk of these tariffs.
Courtney, we still have pharma tariffs still to come. The EU Commission President Ursula von der Leyen was very, very careful to point out and very purposeful to point out this was all-inclusive. There is a conversation here, as I'm sure you're aware, about whether these tariffs actually survive legal proceedings. And for that matter, they believe the White House might actually avoid making a decision on sectoral tariffs until they have clarity on legal issues around things like IEEPA. When you speak to management teams, and I won't ask you a legal question, I just want to understand from your perspective, when you speak to management teams at the moment, do they convey confidence to you that 15% is it, it's the clarity they need and they can move on? Or are they still confused and uncertain about what the future might hold?
It's a great question, because I think not only on this topic, but many others, we've seen kind of volatility on kind of what actually gets implemented relative to what gets announced and over what time horizon. And certainly when you're making large capital investment decisions, like you might be if you're initiating a new plant here in the US or even expanding one that already exists, you need quite a lot of certainty. And so while almost all of the large cap pharma companies have announced capital commitments here in the US, many have not yet begun actually initiating that spend or breaking ground or those expansions yet. And that is because first they were waiting for what was going to be in the most recent bill in terms of the extension of the Tax Cuts and Jobs Act. And so what would be the rebates or the additional benefits they may gain from the tax incentives of investing in America. So that was one side, and we've got more clarity there. And then the second side is, well, how long does this tariff persist for? At what rate? Through which countries, and how does that compare to the fundamental growth drivers in my business and how those fundamental growth drivers are exposed to manufacturing in those locations. So yesterday we began kind of earnings of my covered companies, and Merck was one of those companies that presented yesterday. And we did hear from them that they are waiting for more clarity from both the administration and kind of anything that gets kind of really ratified and implemented for them to be able to fully validate, particularly beyond 2025, what the impact might be to their business.
Courtney, thanks for making time for us this morning. Appreciate it. Courtney Breen there of Bernstein on the latest with pharmaceuticals and the tariffs they face now and in the future. This from the president just moments ago. The August 1st trade deadline won't be extended.
Which is the reason why people are expecting letters, as you were mentioning earlier, to the nations that do not necessarily get trade deals. Again, what are these trade deals, though, since they are pretty not necessarily teased out in full, sort of trade agreements, MOUs, and that seems to be where we're at.
Let's get you an update on stories elsewhere. Our top stories worldwide with our Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. Adidas reported weaker than expected revenue growth, sending shares plunging to their biggest intraday drop since April. The company only reaffirmed its annual forecast despite a bump in profit during the second quarter. The CEO cited uncertainty around the impact of U.S. tariffs, echoing the concerns of its rival, Puma. Meanwhile, Apple has lost its fourth AI researcher in a month to Meta. A key engineer is joining Meta's superintelligence team, and Apple is now weighing a pivot toward using more third-party models like those of OpenAI and Anthropic. But sources say that's hurting morale within its AI team. And the Aston Martin Formula One team will be valued at around $3.2 billion in its latest stake sale. CEO Adrian Hallmark said that the team's listed car maker has agreed to sell its minority stake in the team for nearly $150 million. He declined to name the buyer, saying the deal had yet to be completed. That's your Bloomberg brief. John?
Yahira, thank you. Thank you very much. Up next, making the case to cut rates.
I don't think I could be any more clear, I hope, as to what my position is and why I think we need to do this. It's just how I read the data. Some people don't want to cut, some do want to cut, but coming out and making the case either side, that's good, healthy debate.
Up next on the program, we'll catch up with the former St. Louis Fed President, Jim Bullard. A statement from the President of the United States just moments ago from President Donald Trump saying the following: the August 1st deadline is the August 1st deadline. It stands strong and will not be extended. It's a big day for America. That's a big day that's 2 days away. For today, we're looking ahead to a Federal Reserve decision later on this afternoon. Under surveillance this morning, making the case to cut rates.
I don't think I could be any more clear, I hope, as to what my position is and why I think we need to do this. It's just how I read the data and how I think about going forward, how you respond. Some people don't want to cut, some do want to cut, but coming out and making the case either side, that's good, healthy debate. Otherwise, if we're always going to do the same, the joke is, why don't you just have one person set policy and send the other 18 FOMC members home?
Here's the latest this morning. At least one Fed official preparing to push back against keeping policy unchanged today. Some Fed watchers looking for two governors to dissent for the first time since 1993. The former St. Louis Fed President Jim Bullard telling us previously, I think that the Fed could resume its normalization process. September would be a natural focal point for that. Jim joins us now for more. Jim, welcome back, sir. Just how compelling is the case for lower interest rates today?
I think the policy rate's a little bit high for the current environment, and so I do think that the committee could set up a September rate cut at this meeting. I think the risk for the chair is probably that that gets priced in even more than it already is, and he can't preserve enough optionality going into September. But I'm sure he'll do a good job on that part. So I think the committee's in pretty good shape here.
Do you think that it's good to see dissent, that that's actually healthy and important right now?
I've always felt that dissents show, in some circumstances, they just show that there's a lively debate and that various points of view are being heard, and that can be helpful to the chair. I think sometimes the Fed gets criticized from all sides, and sometimes when it's always unanimous, you get criticized for that as well. Too much groupthink. So I think dissents can be valuable.
A lot of people are watching today's meeting, press conference, for any clues of what type of pressure President Trump seems to be exerting, at least psychologically, on the Fed. I wonder how much of a cloud you think that is. As a former Fed member, I know you're probably going to say it doesn't factor into their mentality, et cetera, et cetera. At the same time, the rest of the market is perceiving it that way and is taking everything that happens on the FOMC as, oh, this person is running to be the next Fed chair. Oh, this person is just trying to show their defiance to the president's discussion.
Yeah, I don't know. I don't think the committee pays too much attention. There's a lot of data, a lot of analysis. That's the way the meeting works. It's a big formal meeting. And, I think every member takes their role extremely seriously. And if they feel like the data is pointing them in one direction or another, they make the call, and that's that. So I don't really think the theater affects that part of the discussion.
So, Jim, let's talk about the data and where we are by the time we get to September 17th. 2 more CPI reports, 2 more payrolls reports. And there's an assumption right now from some that they've got to wait. And they've got to wait because they need to see the tariff pass through to consumers. How much will we see? And once they've seen it, to what degree will it hang around? To what degree will it actually be transitory? Or will it be sticky? Jim, is 2 CPI reports enough to draw any conclusions on that?
They're going to want to see that data going into September, and that'll carry the day here today, I think. And they'll, who knows? You can always get surprised by the data. You've also got jobs reports in there, so they'll want to see that before they make a decision. That'll be the basic idea. But I think the notion is that they've already put the recalibration policy on pause for the first 6 months of 2025, waiting to see what the tariff policy would be and whether it would feed through to inflation. They didn't really get anything out of that. And that's why the policy rate's sitting a little bit high compared to inflation readings and unemployment readings right now.
And James, do you think that it's fair to think that next year you're going to see some pretty significant rate cuts, not just because of the new Fed chair, but because you think it could be appropriate based on potentially ongoing disinflation?
I think it is going to be appropriate. And I think if they make 2 rate cuts this year, September and December, and then they follow that up in the first half of 2026, they would start to get to the neutral rate. What the committee thinks the neutral rate is, maybe 3% or 3.25% or somewhere in there. And that would be the exact rate that you should be at if inflation continues to decline toward 2% and unemployment continues to be in the low 4% range.
Hey, Jim, appreciate your input as always, sir. The former St. Louis Fed President Jim Bullard there weighing in on the decision later on this afternoon. Market's comfortable with this. You look at the forecast from the Federal Reserve for inflation, for the dots where rates are going to be. Ultimately, the Fed is communicating inflation goes up, it comes back down, and we'll be cutting interest rates. The market's OK with this because they don't see hikes. They see a bias to reduce interest rates. Now, will the market be OK when they start to sense a bias to wait? To wait? And to wait a little bit longer. And that's the debate, not for today, but for September. I really want to know whether 2 CPI reports is enough to draw any conclusions about the trajectory for inflation beyond September and into next year.
Just a cheat sheet, you're probably not going to get the answer to that today because the goal will be to watch paint dry. And so let's see if they can accomplish that goal.
He's got every reason in the world to make this boring.
Yes, well, he usually does. But let's see if he could actually
Can he execute?
Yeah, exactly.
In that news conference. Up next, we'll catch up with Joseph Amato of Neuberger Berman, Shweta Khajuria of Wolfe Research, Blake Gwinn of RBC, and Claudia Sahm of New Century Advisors. From New York, the second hour of Bloomberg Surveillance, or the third, we're losing count.
Whatever.
That's up next.
There is a little bit of a handing off of the baton here from trade and taxes to the Fed.
The Fed shouldn't be cutting rates. They're not in the position to cut rates.
I expect Fed's playbook isn't going to change a whole lot.
Risk assets don't really care as long as the idea of rate cuts keeps being alive. That is totally fine.
The question really is, of course, around the September meeting.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, live from New York City this morning. Good morning to you all. The opening bound 90 minutes away. Your scores look like this. Equity futures on the S&P 500 positive by a tenth of 1%. On the Nasdaq up by 0.2. Coming up over the next 24 hours, absolutely packed with data, with earnings, and sandwiched in between, a Federal Reserve decision with Chairman Powell.
Yeah, and in about a half an hour time, we get a Treasury refunding announcement that might have more import for the bond market than even what we get from the Federal Reserve, because it will give a sense of just how much the U.S. government's going to lean on short-term debt to fill its coffers rather than the long-term bond. I am curious, though, about what the Fed can possibly say to give a better guide at a time when they're under so much scrutiny. And basically, the status quo would be hold 2 dissents, first governor, 2 governors dissent since 1993, and kick the can to September.
Get to September, 2 CPI reports later, 2 payrolls reports later. Is that enough information for the chairman to get a consensus about what to do next?
The key issue for them is to really understand consumer demand and how it responds to potential price hikes. If CPI does go up as expected, the one-time price shock that a lot of people are talking about from tariffs, how do consumers handle it? And they're going to be gauging that too. It's not quite as simple as how do you look through this? It's does consumer demand hold up and accept higher prices, or is there that price sensitivity that causes companies to kind of accept more from the margins, push it back onto suppliers, and really have a shelf life for those price increases?
That's why emphasis in a news conference is really important. Will the chairman put equal emphasis on the firmer goods prices we've seen and are expecting over the next few months, as he would on the softer services prices we've seen recently? If you put equal emphasis on both, then maybe you can say we're open-minded about the situation. But if you choose to overweight one versus the other, that's going to be interesting to read through what that means for policy.
Especially because policy will be set by him maybe for a couple of months more, but not by him maybe next year. And others in the committee clearly are putting the emphasis elsewhere. We certainly heard that from Chris Waller, but we also are hearing that from some regional Fed presidents as well. And I do have to say the fact that Treasury Secretary Scott Bessent talked about how they were considering some regional Fed presidents as well, potentially for the seat of the chair. There is a question about whether there's going to be more dissent represented here and whether there will be more emphasis on some of the services disinflation and consumer pushback to price increases.
The formal process to replace Chairman Powell is underway. Equity futures on the S&P positive by a tenth of 1%. Coming up this hour, Joe Amato of Neuberger Berman as stock snappers 6-day winning streak. We'll catch up with Shweta Khajuria of Wolfe Research previewing earnings from Meta, plus Blake Gwinn of RBC reacting to this morning's data and the refunding announcement in about 27 minutes' time. We begin this hour with Stock Steady ahead of the Fed decision at 2 p.m. Eastern Time. Joe Amato of Neuberger Berman writing macroeconomic policy supports a soft landing scenario. As inflationary pressures continue to soften, we believe the Fed has more flexibility to ease policy. Joe joins us now for more. Joe, good morning.
Good morning.
How much flexibility does the chairman have later on this afternoon?
Well, he's got a couple of his team members who are dissenting, so that puts, I think, him in a little bit more of an awkward spot. But I think the Fed has been in a process to normalize rates over the course of the last period of time, and it got derailed a bit by, of course, the tariff announcement. So I think there's still a movement toward that normalization process, which we think they're going to get back on track on. We think there'll probably be a couple of cuts this year, not today, of course, but probably in September and later in the year, reflecting the fact that inflation, while edging up a bit, has still been under control, and the labor market, while again solid, still showing some signs of weakening. The number coming in Friday is going to be one of the lower numbers we've had over the course of the last number of months.
How much is the bullishness in risk assets predicated on this idea that there will be 2 rate cuts from the Federal Reserve in 2025?
I don't know that broad market bullishness has got to be driven by rate cuts. I think you have within the internals, if you think about small caps. So small caps, I think, do need to see a movement toward lower rates and rate cuts, and that historically has been sort of a catalyst for small caps to rally. But I think what we've seen over the last number of months is the hard data has held up well, broadly. We've gotten some good news on tariffs off, of course, the panicky early April announcements, and I think the markets reacted to that. And many businesses are responding quite dynamically to this issue of tariffs and maintaining margins. We're going to see a little bit of margin pressure in this second quarter, but margins are still at pretty high levels, remarkably, because tariffs have been in place for a number of months now.
So it raises the question about earlier this year, how so many people wrote off the United States as being the biggest loser from some of these tariffs. And suddenly people are coming around to this idea that maybe that was too fast. Do you think that sort of the Fed is a sideshow to really the crux of who is going to bear the brunt of it? And our U.S. companies showing in all of these earnings reports time and again, they're doing just fine, better, in fact, than those in Europe.
I don't think the Fed's ever a sideshow. But as it relates to
it might be today.
The notion of tariffs, you have three ways it can go, right? You either put price increases to customers and they eat it. You put a little, you eat it as the company and pressures margins, or suppliers eat it. So it probably ends up being a combination of that. We've seen inflation tick up a little bit. There's signs of that right in the last inflation report, particularly around things like apparel and home furnishings. You see the margin pressure I referenced, and then we don't really have transparency to supplier income statements per se, but there's probably some pressure going on there as well. And remember, goods are only a portion of the inflation CPI number. It's not the full number. And like you referenced just before, right, services have been softer than expected.
I think Lisa was attempting to get you to defend your overweight in European equities. So let's be more direct. Can you defend your overweight in European equities?
We've moved early in the year to a theme of broadening out, right? U.S. certainly had, was the major driver of markets over the course of the last number of years, but we did think there'd be a broadening out. Now, that broadening out would include small caps, value, non-U.S., right? We're very bullish on Japan. Europe, we think with fiscal stimulus, particularly out of Germany, I think is going to show improvement, and the relative valuations were attractive. So we upgraded our developed markets outside the U.S., which would include, of course, Europe and Japan. So we're sticking with that. We're not underweight U.S. because U.S. still has so many competitive strengths, particularly the tech sector. Like if you look at this second quarter earnings, S&P 500 earnings ex-tech will be flat. Tech's up 17%.
Yeah, but what's
which
Europe's
blends
tech?
To up 7, whatever the number comes
But
out.
what's Europe's tech? It's not weight loss drugs anymore.
It's not.
Novo Nordisk didn't
Europe
work.
is a more cyclical economy. So if you get higher nominal growth rate spurred by, they have lowered rates, you get some fiscal stimulus, the cyclical nature of Europe's economy will improve, and you have the relative value differential from a valuation standpoint. To me, it's not necessarily a long-term secular or strategic allocation per se. It was more of, I don't want to call it a trade, but it was more intermediate term opportunity.
Which is one thing that we've seen with respect to the dollar and sudden strengthening on the back of some of the announcement that we've heard with the EU and European Union and how the tariff agreement kind of got tied, and suddenly this realization maybe there'll be a little pain in Europe. And I just wonder, if you see a cheapening in European assets at this point, is that a buying opportunity or is that a sign that this trade is over?
Well, I think it represents a buying opportunity. We're not looking for opportunities that last a month or two, right, in the context of allocating it to clients. So we're looking for something that has some legs to it. We think the amount of fiscal stimulus that's going to go into the ground in Germany is massive relative to the size of that economy and the European economy. We haven't seen that in a long, long time. So I think that does have some legs to it in terms of the opportunity. The dollar took a very significant pullback, right? So that's rare to see it move that fast, that much. We still think the dollar will grind lower over time, but because U.S. hard data is held up and rates have probably stayed up higher a little longer than expected, the dollar has come back.
Are you expecting any adverse developments in bond markets in Europe that might hold back that equity story?
We do worry a bit about that, right? If you look at the fiscal situations of different countries in Europe, while Germany has lots of room to stimulate, there are other countries in the region that don't, in terms of what their local bond markets are. So we are watching that closely in terms of the spreads in whether it's, Italian bonds versus bunds or versus treasuries or what have you.
So
but I think they have enough room right now to stimulate.
So how do you play the European story at the moment? Someone might look at this situation and say, okay, I buy an ETF that tracks the Eurostoxx 50. Is that the way to do it, or is there a better way to do this?
Well, we're an active manager, right? So we have strategies that manage, European stocks or what have you. So we're looking at high-quality global companies that happen to be domiciled in Europe that have flexibility We'll get some benefit from a local economy being stimulated, but we're still looking for quality companies that have global reach.
That overweight, of course, Japan and Europe. Not on India. This just dropping from the President of the United States just moments ago. India will be paying a tariff of 25%. This just dropping from the president just moments ago.
Yeah, a huge disappointment for Narendra Modi, given the fact that they were looking for something closer to that 19% that we saw from Thailand. It raises this issue that we were talking about earlier. What were the main sticking points that ended up with a tariff agreement that was substantially higher than the region expected? And frankly, something that a lot of retailers in particular are going to have to factor in if they move their manufacturing there and produced a lot of textiles in particular.
This from the president, the statement just dropping just moments ago. Remember, while India is our friend, we have over the years done relatively little business with them because their tariffs are far too high. The president goes on to say among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country, a 25% tariff for India.
Yeah, he also went on to mention Russia and saying that India has always bought a vast majority of their military equipment from Russia. They also are some big energy buyers from Russia. Suddenly, this goes back to what we were talking about earlier. This is a key negotiating tool. The geopolitical positioning, what the relationship is with different countries and Russia, how much they are going to connect with China, that is all part of the tariff negotiation in a very different way than previous years.
That's the latest on trade this morning. Joe, it's good to see you. Thanks for dropping by. Thank
Great.
you, sir. Joe Amato there of Neuberger, Berman. Let's get you an update on stories worldwide, including on trade, with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Exactly, John. The U.S. and China have wrapped up 2 days of talks in Stockholm. The Chinese trade negotiator says they agreed to extend their 90-day tariff truce. But Treasury Secretary Scott Bessent says the Chinese may have jumped the gun a bit. Bessent says extending the pause another 90 days could be an option, but the final decision would be up to President Trump. Meanwhile, Gucci sales plunged in the second quarter as shoppers turned away from Kering's biggest brand. The 25% decline at the Italian label matched analyst estimates. Gucci does have a new artistic director, but he has yet to unveil his debut collection. His predecessor lasted only 2 years in the job. Kering will also see a new CEO arrive in mid-September. And JP Morgan Chase and Coinbase have signed a deal that will let customers directly link bank accounts to crypto wallets starting next year. This move follows a recent announcement from JP Morgan that it will charge fintech companies from accessing customers' information. Users will also be able to fund Coinbase with Chase credit cards and rewards points. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next, the morning calls, plus Shweta Khajuria of Wolfe Research previewing earnings from Meta, and we'll have the latest ADP employment report from New York. This is Bloomberg.
Unless they signal that the inflation data they got a couple weeks ago actually changes their thinking and their thought process on the path of rates, I think, the market, this is going to try to be a nothing done type event. There's always a risk, and I think the risk here is that they skew a little bit more hawkish. Unemployment rate's been the most important data point you get, for a while now. If you get the unemployment rate rising up to around 4.5%, then in our view, a couple rate cuts is not nearly enough, and that'll put a lot of pressure on the Fed to cut more aggressively.
No sign of that this morning. The ADP report just dropping. It's an upside surprise. 104,000 against an estimate in our survey of 76. Let's get you an update with Mike McKee. Good morning, Mike.
Good morning, John. Well, it was a negative 33,000 last month, so ADP not quite in line with what we're getting from the Bureau of Labor Statistics. So we'll see what happens on Friday. But the numbers underneath, the categories themselves are kind of interesting. 7,000 jobs created in manufacturing and 15,000 in construction. Both of those were low last time from the BLS. Service providing jobs were up 74,000, including 46,000 in leisure and hospitality. Now, that would probably be because of seasonal factors, kids getting summer jobs. But we've been hearing a lot about how there aren't any this year. So it's going to be very interesting to see how that breaks down. A loss of 38,000 jobs in healthcare and social services. That's the big category that's been growing forever in the BLS numbers. So some interesting sectoral numbers from the ADP. Also, they do track pay gains, and those who stayed in their current job got increases of 4.4%, and those who left their jobs and got new ones had increases of 7%. This is, of course, as always, the most important indicator of them all for Lisa, except for anything else that comes out.
Mike McKee, she gets very excited about ADP. You know that. Mike, thank you. And the quarterly refunding announcement at 8:30 Eastern Time.
Well, I am very excited for the quarterly refunding announcement. It's unclear what to do with this, since it seems like markets aren't really taking that much of a signal from this. You're not seeing a huge response in markets, and people tend to not see the correlation with this and what we get on Friday. Nonetheless, I think about what Neela Richardson says, which is this is not a market that's falling out of bed. You are seeing signs of potential weakness, particularly with those new graduates or teenagers looking for a summer job. But this isn't exactly something that's fallen off a cliff.
We've got a lot to get through this morning. It's not just the data. We'll get more of that at 8:30 Eastern Time. We need to talk about trade. This is quite a statement from the President of the United States. It came just moments ago. So if you're just tuning in, I'll share it with you now and read it out verbatim. While India is our friend, we have over the years done relatively little business with them because their tariffs are far too high. The President goes on to say, among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country. Also, and this is the additional point the President makes this morning, they have always bought a vast majority of their military equipment from Russia and are Russia's largest buyer of energy, along with China, at a time when everyone wants Russia to stop the killing in Ukraine. All things not good. India will therefore be paying a tariff of 25% plus a penalty for the above starting on August 1st. Thank you for your attention to this matter.
And it goes to the heart of how Russia has been an increasing part of its negotiations, trying to tighten the screws there, and really coming as a surprise at a time when a lot of people were expecting the end tariff rate on India to be something around 20 or 19%. So highlighting a change in tone around Russia and a change in tone around what the parameters are of negotiation for some of these new trade agreements.
Going into that deadline this coming Friday. If you are just joining us again, look at futures this morning. We're doing OK. We're positive by about 0.1% on the S&P. That's the price action. Here are some morning calls. First up, Citi downgrading Union Pacific to neutral, citing questions over its deal to buy Norfolk Southern. Your second call from JP Morgan raising its price target on Boeing to 251, noting its solid second quarter results. And finally, Morgan Stanley raising its price target on Nvidia to 200, citing exceptional AI strength. Let's stick with big tech. Investors are waiting the next round of Mag 7 earnings. Meta, Microsoft report after the closing bell. Ed Ludlow joins us now with more. Good morning, Ed.
Yeah, good morning, John. It's going to be an evening where we try to do a lot of math, right, with a real focus on capital expenditures. We know the story. Meta and Microsoft both have told us that in this fiscal year, there will be capital expenditures of just north of $70 billion. But the thing that the Wall Street's trying to work out is, like, what's the math coming out the other end? So in the quarter that each company is going to report, Microsoft's expected to tell us that capital expenditures are up 30% from a year ago, but overall revenue growth 14%. Meta's expected to tell us that capital expenditures are up 100% from a year ago, but revenue up 15%. So that's going to be a question of how much patience and tolerance the market has for each of these companies to say, well, actually, we're seeing that translation of AI investment into top line growth. Microsoft's a little easier, right, with Azure, because they often tell us our cloud growth was 34% is the expectation for this quarter. Of that, there was X contribution in terms of percentage points from AI. In Meta's case, it's a little bit less easy to calculate and understand. So then you go to management and how much you believe them, which is the fun of having an earnings call in quick succession.
Looking forward to your coverage, Ed, later on this morning on Bloomberg Technology, and then this afternoon when we actually get those numbers from big tech. Looking ahead to Meta, Shweta Khajuria of Wolfe Research reiterating her outperform rating on Meta with a 750 price target, saying we expect Q2 revenue to beat street estimates, in part driven by FX tailwinds and resilient demand. Shweta joins us now for more. Shweta, welcome to the show. Let's talk about what you are expecting beyond just the numbers in Q2. What about the outlook for spending from Meta? I think we might have a connection problem with Shweta Khajuria of Wolfe Research with the microphone, Bramwell.
Can you hear me?
Yes.
I think we've got the microphone up now. Shweta, carry on, please. If you heard me, I didn't hear you. So if you remember the question, please.
I did hear you.
Help me out.
Yes, I did hear you. And good morning, and thanks for having me. Yes, beyond the top line numbers, even though we expect a beat on the expenditure side, we think the number one focus is going to be OPEX and CAPEX. And I think Ed before me was just talking about that. We actually do expect Meta to even potentially raise their CAPEX guide one more time to even above $72 billion for this year. And more importantly, investors will be looking for how they talk about elevated CAPEX spend over the next few years. We actually have almost $100 billion of CAPEX for next year. Maybe 90 to 100 billion is where most of the investors are, even though consensus is calling for a significantly lower number. I think that those numbers are going to go up. And that is a key question.
Shweta, the other issue is how much they're spending and on what, right? I mean, they are giving these $100 million bonuses to try to attract a lot of AI talent. What's the vision here? The metaverse was one thing. Is it just to become more efficient? Is it to have the best kind of targeted advertising? Or is there some sort of bigger sea change goal that will redefine this company once again?
Well, Meta is trying to do quite a few things with AI. On one hand, it's their core platform, so both automation of advertising in terms of content creation and helping advertisers improve their ROAS, and improving user engagement for all of us to be making more engaged videos so that we spend more time on their platforms, and not only sit back and lean back sort of engagement, but also more interactive engagement is where they're headed. On top of that, they're also investing more on what they call business messaging for WhatsApp for all those sellers, and that will need a lot more compute in addition to directly competing with Gemini and OpenAI with Meta AI, their new app that it's standalone now that does something very similar. And then finally, they're all of this coming together with their hardware, whether it is glasses or AR or VR hardware. So all of this will likely require a significant amount of compute, which is what they're building ahead of time.
Shweta, I remember when we used to think about Meta or Facebook as a social media company and directly competing with advertising and the like. Who are their main competitors now?
Well, it is increasing. It's a great question. It's increasingly becoming more of an entertainment company. So yes, it is social media, and historically we've seen it as competing directly with TikToks of the world, whether it's TikTok or even Pinterest or Snapchat, but increasingly so because of the consumption. It is now becoming more of an entertainment company, so even YouTube and any of the CTV sort of competitors, where do consumers actually spend time, is where they're competing, and that includes Netflix, Amazon Video, YouTube, and all other entertainment platforms.
Shweta, I know you've got to run. Thanks for that, and our apologies about the connection.
Thanks for having me.
Thanks for being here. Appreciate it. Shweta Khajuria there of Wolfe Research on Meta. That stock is up 20% so far this year.
Yeah, a huge rebound since April 2nd. Where are we in the year? It goes to show how high is the bar for the likes of Meta and Microsoft that report after the bell today. Is it crucial for them to show blockbuster earnings and the promise of hopes and dreams in terms of their capital expenditure spend in order to maintain a rally that has propelled the entire stock market in the United States?
I know a lot of this year has been exhausting, but it's flying by. After the Fed decision today, there's only 3 left for 2025.
Yeah, and those are going to be really important 3, given the fact that this market is expecting them to cut rates twice in that period, amid a search for the next Fed chair, which might be currently sitting in the Fed governorship or even potentially one of the regional.
Who knows? We're going to find out in the next several months, potentially. That decision comes later. Coming up next, we've got some economic data, including GDP, plus a Treasury refunding announcement. Mike McKee's going to break down all the details in just a moment, and we'll get the reaction from Blake Gwinn of RBC. Live from New York City, you're watching Bloomberg TV. Live from New York City this morning. Good morning to you all. Lots of economic data still to come, including the Treasury refunding announcement in just a moment. That's all going to come at 8:30 Eastern Time, so 15 seconds away. The scores into that look like this. Equity futures positive by 0.1% on the S&P. On the Nasdaq 100 up by 0.1. In the bond market, the 2-year, 10-year and 30-year. Yields a little bit higher this morning, up by 2 basis points at the long end, up a basis point, not even, on 10s. 432. With the data, with the headlines, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, we've got a stronger than expected GDP number, 3% for the second quarter initial read. That's up from a 0.5% in the first quarter. 2.6% was what was forecast. Now, the interesting thing, of course, is we've got to break that down by category because we had the trade distortions in the first quarter. So let's look now at the GDP personal consumption number. Comes in a little weaker than anticipated. It's up by 1.4%. The forecast was for 1.5%. Gross domestic private investment, non-residential fixed, 1.9%. That's down from 10.3%. A lot of anecdotal reports that businesses were holding off on spending, and it looks like that indeed is what happened. Equipment spending fell from 23.7% gain to a 4.8% gain during the month, and intellectual property, software, etc., rises only a little bit, 6.4% from 6%. Looking at net exports, which should at least provided a big jump in the Atlanta Fed GDP now last week, or last reading. Exports were down 1.8%. Imports were down 30.3%. They had risen by 37.9% in the first quarter. So we know this is basically an import story and also an inventory story. Inventories down $185.5 billion. They were up $151.6 billion in the first quarter. So you've got inventories working against you. You've got trade working for you. And it looks like between the two, we really get a stronger than expected report because spending is not as strong as it was anticipated. Yeah. And the key number for us today is going to be real final sales to domestic purchasers. And right now, we're looking to see exactly what we got there at an annualized rate. 1.1%, down from 1.5%, 1.9% for domestic purchasers in the first quarter.
Mike, we'll let you look through all of those numbers from the GDP. I do want just one word, though, from you on the Treasury refunding announcement. That quarterly refunding announcement has been hotly anticipated. It looks like they are maintaining the total volume of sales, but they are doubling their buybacks of longer-term bonds. What is the significance of this? Can you tell us the expectations versus the actuality of the way the U.S. is going to finance its debt?
Well, they had anticipated increasing the number of buybacks. What they're trying to do is take old off-the-run bonds out of the market because nobody really wants to trade those. And so they buy them back. And then if you're looking for bonds, you've got to get newer ones. And that gives you a better price discovery. So they're going to 4 per quarter. The other big issue was what are they going to do about bills? Because Scott Bessent's been critical of the Yellen Treasury terming out their sales. They're going to increase their short-dated bill auction sizes in August and October, but they say that is because they are rebuilding the Treasury General account now that we have spent a lot of that money on the debt ceiling. Since that's been fixed, they're going to do that. And they don't expect any other changes to auction sizes for the next several quarters. $58 billion this time in 3-year notes, 42 in 10s and 25 in 30s. It's a slight increase in 10s and 30s, but then they anticipate keeping that level for a couple of quarters.
Mike McKee, thank you, sir. Stay close. Bond yields higher, up 3 basis points on 10s to 4.35 on 30s, up 3 basis points to 4.89, just unwinding some of the rally we saw develop in yesterday's session.
And part of that was on the expectation that there would be a real sort of retracement from issuing on the long end. In other words, issuing bonds more on the front end and even reducing some of the bond issuance on the long end. You didn't see that today. Hard to parse through whether the move is more on that or the fact that we got above the expectations when it came to GDP.
Blake Gwinn of RBC Capital Markets joins us around the table. Blake, good morning.
Morning.
This was a big focus for you this morning.
Absolutely. Yeah, I think so. What we got here, just looking at the headlines, and obviously when I get back to my desk, I'll be looking through some of the details a little bit more closely. But I think this is pretty close to what we thought was the consensus or priced in, the priced in outcome, that this would be the most market neutral. I think, just what we've seen initially, bond markets seem to be taking this pretty well in stride. I think if you would have gotten a more aggressive communication around shortening the WAM, if you would have changed some of that forward guidance where Treasury is kind of committing to not, to not increase coupons over the next several quarters. If you've gotten some change there, maybe we could have seen some follow-on flattening, some follow-on rally to what we saw yesterday, but I don't think this is enough to really carry that through.
There are certain tools available to Treasury. Lisa mentioned one, boosting the buybacks in 10, 20 and 20 to 30-year buckets. What does that mean, ultimately?
This is, I think, been the biggest focus for us in a lot of our conversations with clients, because I think there's a real almost desire in markets to try to make these buybacks into a QE type of program that we saw the Fed do. But there's some very, very big differences. So they doubled the size here. They were in the long end, so 10s to 30-year buckets, they were buying about $8 billion a quarter. When you look back at the last QE program we had from the Fed, I mean, they were buying $40 billion a quarter in 10 to 30 year, 40-ish. So much bigger in size. So even with this doubling, we're still far from the size of what they were buying in the long end from the Fed. But I think the bigger issue is really the mechanics by which they buy it. And what I mean by that is the Fed is a completely price-insensitive buyer that had to buy those securities every quarter. So if you have a big price-insensitive buyer that come or hell or high water has to buy $40 billion every quarter, it's very different from what I think these buybacks represent, which is somebody who's saying, we may buy up to this amount. If things cheapen up enough, if things look attractive enough, we'll come in. But that's more a cap. We could also buy zero. So if you look at those two different scenarios and how you position for that and how it should impact markets, how it should impact yield levels in the curve, very, very different things.
So right now we're seeing the refunding announcement not necessarily causing the bulk of the move, the small move as it is, in terms of yields just ticking higher. It really is coming on the better than expected economic data. Are you saying that essentially if the Treasury remains pat, things will remain as such, but if they do start to issue more on the front end at the expense of the long end, that could cause a pretty substantial rally? Is that what you're saying?
Well, I think there's varying degrees of this, right? Because I think what they're already doing in a way is kind of communicating that they're going to focus more on front-end issuance, because saying that they're not going to increase coupons for several quarters now, you're getting to the point where, given the financing needs that are coming, if you're not doing coupons in the next couple quarters, it means you're leaning more heavily on bill issuance on the front end. So even if they do nothing, even if they just maintain this kind of forward guidance that we're not changing coupons, you're going to see bills and short-dated issuance become a bigger part of the package, just naturally. So I think what markets wanted to see was something less passive and a little more active, where Treasury is actually saying, no, we are doing this, we're shifting, we're going to use these buybacks more like a QE program to really push down on yields, to push down the curve. But that's not what we got today.
We've gotten a taste of the summer of the pain trade. The idea that all of the consensus bets in the first half of the year were challenged over the past couple of days. The idea that you could short the dollar, long the euro. The idea that long rates were going to keep rising. The idea that Europe would keep outperforming over the United States. Does that have legs because of the dynamic that you just said in the rate market in particular, that you could see an ongoing flattening rather than that steepening?
So the way we've been kind of viewing it is, rather than these kind of issuance discussions really being a force to push yields lower or to push the curve flatter right now, the way I'm viewing is it's really reinforcing the kind of ceiling that we've seen. As we've seen basically since April, really the whole year, anytime 30-year yields have surpassed 5%, they very quickly trade back down. Within a session or two, they're back down below 30. So we're getting this really kind of range-bound trading. And I think having this discussion around WAM and knowing that the Fed, knowing that the Treasury seems to be focusing more on front-end issuance, even if it's just passively, I think that's enough to keep this kind of soft ceiling on yields. And that's probably reinforcing the top end of the range that we've been trading in. Now, if they go more active, if they really start to communicate a little bit more, that's where we start to see the downward pressure and really breaking out of the bottom side of those ranges.
Second quarter GDP out just moments ago comes in at an upside surprise of 3%. The estimate in our survey was 2.6. Mike McKee still standing by. Mike, just to dig deeper into the economic data, for those of you out there that missed all of this, Mike, just go through it again. How much are the net export numbers flattering the overall story for the U.S. economy?
Oh, tremendous amount, John. We saw net exports fall by $1.026 billion. That's down from $1.359 billion. And the contribution to the change by net exports was almost 5%. So the 5% subtracted from quite a bit from what we saw. And of course, we had a big rise in the first quarter. Also, though, the surprise is the slowdown in spending on both the consumer and business side. The personal consumption is up by just 1.4%. Now, that's a little bit stronger than the first quarter, but it is relatively weak compared to what we were seeing. And non-residential fixed investment falls from 10.3% in the first quarter to 1.9%. On a 6-month basis, which is kind of the way you'd want to look at it, given the trade and inventory distortions we've seen, the first 6 months, first half of 2025, growth has averaged 1.25%. In the last 6 months of 2024, growth averaged 2.75%. So a significant slowdown in the economy over the last 6 months. The president's critics will say it's his fault for the tariffs. The president will look at the top line number, I'm sure, and talk about nominal growth being stronger.
He's got some thoughts on that already. Hey, Mike, thank you, sir. Mike McKee with the latest. It's not an argument you often hear on Wall Street that growth is so good, cut interest rates, but it's an argument we're getting right now from the president. Second quarter GDP just out, 3%, way better than expected. Too late, Chairman Powell must now lower the rate. No inflation, let people buy and refinance their homes.
There is this theory coming out of the White House that sovereign risk, developed market sovereign risk, should be equated to credit risk, where the higher the rating of a country, not a company, should get a lower benchmark borrowing rate akin to the likes of Microsoft or Apple or Johnson, one of these major companies that have lower borrowing costs relative to their peers. That is not the way traditionally it has been viewed. It traditionally has been viewed as a rate for developed markets tied to inflation and growth that should be higher with faster growth. And yet, it's a sort of unconventional take on the economics of today.
Blake, final question. How much of a snooze is this meeting going to be today?
I don't have high hopes, let's be honest. We're watching to see if there's any dissents, but, how exciting can that really be?
I'll make it easy for you and leave it there. Blake Gwinn of RBC. Blake, thank you, sir. Appreciate it. That decision coming up later on this afternoon, the news conference at 2:30. Are we going to try and make it exciting later this afternoon?
Make it exciting. It just inherently has such drama and excitement. We could just keep repeating that clip of Donald Trump and Jay Powell with their hard hats on and just say, $3.1 billion. I don't see that anywhere. I don't think so. We just replay that over and over.
It's a fantastic impersonation you've got going there.
I'm really doing really well today.
People want to hear you sing again too.
Let's move on.
You missed that from earlier on this morning. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump says India will pay a tariff of 25% starting on Friday. In a post on Truth Social, he wrote, "While India is our friend, we have done relatively little business with them because their tariffs are far too high." Trump also suggesting he would add an additional penalty due to India buying Russian oil. Meanwhile, Palo Alto Networks agreed to buy Israeli firm CyberArk for $25 billion in cash and stock. The deal gives Palo Alto a suite of identity security tools which help users determine who should have access rights within an organization, according to the statement. And Kraft Heinz reported sales and profit that topped estimates. Second quarter organic revenue fell 2%, less than the 2.8% drop that analysts had expected. The packaged foods giant reiterated its outlook, pointing to progress in winning over inflation-wary shoppers. Shares are up 0.5%. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with Claudia Sahm of New Century Advisors on potential dissent on the FOMC. From New York, you're watching Bloomberg TV.
I think the policy rate's a little bit high for the current environment, and so I do think that the committee could set up a September rate cut at this meeting. I think the risk for the chair is probably that that gets priced in even more than it already is, and he can't preserve enough optionality going into September.
That was the former St. Louis Fed President Jim Bullard speaking to us earlier on in anticipation of a Federal Reserve decision later on this afternoon. We've got some data to wrestle with. This on GDP. Really, the GDP guessing game of the year so far has all been about navigating trade. This came from Kevin Gordon at Charles Schwab just moments ago. He writes in, first quarter, net exports take the biggest bite out of GDP in history. Second quarter, net exports make the largest contribution to GDP in history. That's the situation of the last 6 months.
Yeah, how much is it a wash? Essentially, you've just seen massive distortions in data as people bring forward their exports, their imports, and then have a lot of inventory. These are the big questions as we grapple with trade deadlines and trying to understand the relevance of a lot of economic data.
The opening bout just around the corner, 42 minutes away. Equity futures positive by 0.1%. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. We're in the thick of earnings season. Humana among them this morning. It's a rare health insurer that has upped its guidance for the year. Basically, everybody else has been cutting it, grappling with higher Medicare costs, medical costs. Humana, on the other hand, says, hey, costs have come in line. It also saw better business when it comes to their pharmacy and their Medicaid Advantage programs. Those shares up 10%. We also had Starbucks earnings after the bell yesterday. It did miss on a couple metrics, but it's all about the turnaround. CEO Brian Nichols saying it is ahead of schedule and that they will be unleashing a wave of innovation in 2026. So get ready for your protein cold foams and more croissants at Starbucks locations. Finally, Visa wrapping up the earnings here. Those shares, though, down 2.6%. It did beat, but the issue with Visa is that they left their guidance unchanged. Analysts had been expecting them to raise their guidance, so disappointment there. But Visa CEO going on to say that it is a consumer who is resilient and continuing to spend. John.
Danny, thank you. Thanks for this morning. We'll continue to count you down to the opening bell. Lots happening in your trading diary at 2 p.m. Eastern, a Fed rate decision. 30 minutes later, a Chairman Powell news conference after the closing bell, earnings from Meta, from Microsoft. On to tomorrow, core PCE and another round of jobless claims, plus results from Apple and Amazon on Friday, the payrolls report, and the president's self-imposed tariff deadline. A lot to look forward to as we turn back to the Federal Reserve. Claudia Sahm of New Century Advisors writing, the possibility of two dissents from Governors Waller and Berman is notable in terms of Fed history, but policy moves on agreement. Claudia joins us now for more. Claudia, welcome to the program. What kind of agreement can we make today at the Federal Reserve? What can we agree on?
I think it'll be really interesting to see if the committee is getting more comfortable, having more conviction in their, forecast that inflation may rise this year, but then, come back down. So I think a lot of this discussion around what are the risks of the persistently high inflation. We know from Governor Chris Waller that he sees those risks as very low, and that's why he's in favor of a cut. But is the committee moving in that direction of, moderating those risks, or is it are they still very much demanding more data to get comfortable with the idea of a rate cut?
Claudia, what do you think? And it matters a lot what you think, because the Sahm rule is often pointed to, and was certainly pointed to at the end of last year for the 100 basis points of rate cuts in the second half. Do you see the same cracks that Chris Waller is seeing?
I don't see this. I can see the cracks that he's pointing to. I maybe don't draw as strong an inference as he does. I do think it's time for the Fed to really be pivoting to, why are you waiting? What are you looking for in the data? What do you need to see with inflation, right? Focus on that, as opposed to we can wait. We saw a lot of discussion at the last press conference about, the economy is solid, the labor market is solid, so we can wait and get more data. And I think there are sufficient signs of weakening. And some of the softening, the risks in the labor market, they've been with us for a while. These are not new. The low hiring rate paired with the low layoff rate, this is not new. And yet we do see signs of demand softening. We saw some of this looking at first half GDP numbers and hiring concentrate. There are just a lot of signs that this is not a labor market that will hold up, indefinitely. And so the Fed needs to back off some, using that as its safety blanket in terms of waiting for more data, and recognize those risks are out there. We hear a lot about the risk to the inflation outlook. We should be hearing some more about the risk to the labor market outlook as well.
There have been a number of people who've speculated that Fed Chair Jay Powell might take an even more hawkish approach to policy, might signal that the labor economy is in a good place and that they're balanced roughly in their mandates, in order to avoid accusations of political interference, that he's getting bullied by President Trump. Do you ascribe to any of those ideas, or do you think that that's a bit speculative?
the best way for the Fed to stay out of the politics as much as it can is to put its head down, parse through the data, be transparent, right? The data don't speak for themselves. We need to hear how is the FOMC interpreting the data? What are they looking for? Like, that's the message he needs to stick with. They're not going to win. The Fed will not win if it plays politics. Like, that's just not the game that it is well suited for, nor should it be doing it. So I think we should just get a lot more of their thinking and just lay it out there. That's part of the transparency. That's part of the accountability that comes with the Fed being the ones that make the decisions about interest rates.
So, Claudia, let's stay on the data. I just wonder if 2 CPI reports is enough between now and September to draw conclusions about how much tariff pass-through we'll get and how much of that tariff pass-through is going to stick around.
2 more CPI prints could give us information both on the tariff pass-through. I mean, the tariffs working their way through the economy, this is going to take time. And we could see, ever rising tariff effects as we go into the September meeting. So, I mean, they're going to have a real explanation of how you would cut into a rising inflation environment. But we have also seen, months of the outside of the tariffs. Look at the housing services, look at the non-housing services. We've had some really encouraging numbers. A few more months of that could, really strengthen the case that underlying inflation, set those tariffs aside, underlying inflation is really moving back down to target. And that is a really important piece. And 2 more months of data in that direction can help bolster the case for a rate cut based on the inflation risks are less.
Do you think they're in a position today and through the summer to keep on saying the labour market is solid, so we have the luxury of waiting? Can they write that in the statement once again this afternoon?
Well, they can write whatever they want to write in the statement. I think it would be misguided. I mean, we have seen various pieces of information about the labor market that point to some weakening. And also, if you are running an economy with below trend growth, and that's, focusing on consumer spending, business fixed investment, kind of the core of it, that weakness does eventually show up in the labor market. And the Fed itself, its baseline forecast shows some weakening in the labor market this year. So it seems completely appropriate to at least be pointing to the risk, pointing to that outlook. I mean, that's, a very reasonable thing to be pointed out. And I think they'll be a little flat-footed if they just keep hanging on to the labor market is doing just fine, economic activity is doing just fine. Because I think that's a pretty one-sided reading of the data right now.
We'll see if we get that change at 2 p.m. Eastern Time. Claudia, appreciate it. As always, Claudia Sahm there, New Century Advisors. Claudia's right, of course, they can write whatever they want. Just how credible is that argument still to keep on saying the labour market is solid so we can wait?
Yeah, well, that's one reason why. How much do you see different views represented? Some people see it as solid. Other people maybe don't necessarily see it as having that same degree of resilience. But Claudia mentioned there about the housing market and how that's been a huge disinflationary force. I wonder how they address that as well. Whether they ascribe that as some sort of leading indicator or whether it's been a cycle unto itself. And that's clearly on the president's mind as well when he points to the fact that borrowing costs are too high to buy a home.
Should we take a little break?
And then come back.
Come back later on this afternoon.
I'm eager.
Special coverage of the Fed's decision just around the corner. Bob Michael of JP Morgan, Diane Swank of KPMG, the former New York Fed President Bill Dudley, Jeff Rosenberg of BlackRock. Coming up tomorrow, Chris Verone of Strategas, Mira Pandit of JP Morgan, the former Kansas City Fed President Esther George, and Walt Piecyk of Lightshed Partners. From New York City this morning, good morning. This was Bloomberg Surveillance.